partner, Accenture, trade media partner, Media Infoline, hospitality partner, St. Regis Mumbai, celebration partner, Radico, Spirit of Excellence, and digital media partner, Daily Hunt. The Business Today Banking and Economy Summit is an iconic signature property of Business Today, where we really take a nosedive into what's happening in the ecosystem and some of the key opportunities and challenges. The banking sector has in fact made a remarkable comeback with record profits, gross NPAs actually halving from the highs that they saw in 2018. There is no threat to financial stability as there was in the aftermath, for instance, of the IL&FS collapse. The banking system is profitable, it's growing, it's adequately capitalized. The temptation for banks now to grow even faster and capture the growth opportunities, especially when it comes to the digital space, the retail space, is visible, and they are actually already on supercharged mode trying to tap into this. They also have to tread a little carefully given the higher level of inflation and interest rates that is likely to impact borrowers' affordability and repayment capabilities. And we look at that among some of the other challenges. For instance, the sustainability of current loan growth and also competition from fintechs. Let me kick off the summit with a very special guest. Banking on a high, the big turnaround and also the challenges ahead. To discuss this, I'd like to welcome Udayan Mukherjee, our Global Business Editor at the India Today Group, in conversation with Amitabh Chaudhry, MD and CEO, Axis Bank.
Hello, ladies and gentlemen. Good to see you here, and welcome to the Banking Summit of Business Today. I'm Udayan Mukherjee, and I'm very happy to have with me one of the smartest bankers in India today, Amitabh Chaudhry of Axis Bank, who has effected a remarkable turnaround in Axis Bank's fortune since he joined a few years ago. And it seems apt to start off this conclave with him by asking him what the picture for banking is looking like for the next couple of years. Amitabh, it's wonderful to have you with us today, and thank you for finding the time.
Well, thank you so much, Udayan. Really appreciate the fact that you invited me to this forum. Yes, when we talk about banking as we stand today, everyone is saying this is the decade, perhaps the best decade ahead for Indian banking, given a lot of factors which are coming to play. Banks' balance sheet, are well capitalized. They've written off most of the losses. The corporate India has also cleaned up its act. Indian economy seems to be the sign of, or representing one of the few economies in the world which is growing. Geopolitical situation seems to be favoring India and all of that. So from that perspective, and the credit growth is also seem to be doing quite well. From that perspective, I think a lot of factors seem to be speaking to this decade ahead where we could be marching forward at a rapid pace. Being a banker, you also need to look at the risks all the time. In my mind, we need to add a dose of caution to this feeling of euphoria. And the feeling of caution comes from a couple of factors. One, while we have cleaned up our act in this desire and this aspiration to grow, all of us have to realize that today we might be making mistakes which could create not a new banking crisis, but create problems for banking going forward in the future. So we have to be very careful about what decisions we are taking today, because they will play out 5 to 7 years down the line. Secondly, there are three, I would say, things which still worry me from a macro perspective. One is that I believe while inflation is coming under control, and there is a report which I saw just a couple of days back which talked about how India might start reducing interest rates. But I would say that given what is happening around in the world, inflation could remain sticky for some time. And one of the factors which is, for example, feeding into this is that China has opened up and China will start growing at a pace all over again. They have something to prove to the world, and, for example, commodity prices could start rising again. Second is, obviously, this looks like the Russia-Ukraine war is entered into an impasse. You don't know what the end game is. You don't know how long it will take. And while it is not impacting India, it is impacting things globally. It does cause people to pause, because when something happens or something flares up, people do kind of pause and say, okay, should I invest, should I not invest? Things could go haywire. And obviously, last factor is China, and what China could be doing from a geopolitical perspective. They have ambitions, they have openly stated ambitions about what they want to do. They don't no longer see themselves as one of the superpowers. They want to be treated as one. They want to be recognized as one, and in that process, they could do things which could again upset the apple cart. They are doing things which seem to upset the apple cart regularly. So, dose of caution, but I think yes, the next at least 5 to 7 years look very, very positive for India. And I will just add one last thing. India has had these moments before. We seem to excel in somehow making a great dish go bad, because our execution is poor or somewhere we go off track. I hope this time we don't.
You're being polite. You mean to say that we shoot ourselves in the foot?
We tend to. History shows that we are very good at it. Everything will be aligned in our favor, but we'll go and do something which puts investors off, puts people off, pushes investments out, takes the narrative from what we should be focused on to somewhere else. And I think while the present government has done a great job in sticking to the knitting, we have to ensure that come elections or come some factors, we don't go off that path. And if we go off that path, we'll again miss a great opportunity for us.
Through the last 5-7 years, I mean, bankers like you have been very conservative because you were cleaning up the mess of the previous cycle. Now that you're saying that is pretty much done, from a management perspective, are you realigning yourself to become super aggressive once again to play a new credit cycle?
So if we were to say that the macro is a bit volatile and macro is a bit uncertain, and by the way, uncertainty is only increased over a period of time, the way I describe it is that we should all behave like a crouching tiger. We should grab every opportunity which comes our way, and there are enough opportunities which will come our way. But at the same time, we should be willing to crouch if things are, become too volatile or it's difficult to define how it will play out. So in that sense, yes, we, as in, for example, in Axis Bank, we have launched a strategy which is called GPS. We are very clear in that strategy that we want to go in market share. We want to become number one, number two in some of our defined businesses. We have taken a very clear stand that we want to create 2 areas of distinctiveness and we'll put disproportionate dollars there. So at a foundation layer, we are continuing to invest in something we believe in, which will allow us to go from, let's say one step in the ladder to a different step in the ladder. But at the same time, we are very cognizant of the fact that we need to crouch if things were to go bad, because things are volatile. So you use the word super aggressive. I think no regulator will like that word, super aggressive, because they'll get really worried. But yes, you can be smart about how you can capitalize on opportunities which present before yourself by investing in technology, looking at next 5 to 7 years, by investing in the right people, by investing and looking at where some of the other competitors are not paying too much of attention, or where you can play and become distinctive over a period of time. So I think that's what we are doing. It is a long play. You can't do this in the short term. But if you keep doing things the right way, you have a long-term vision, I think you can get there over a period of time. And I think some of the things which we have done, where we have gained market share, or what we're doing with the Citibank acquisition, is I think very much speaking to that strategy which we outlined a couple of years back.
You said crouching tiger. I mean, that phrase comes from a film called Crouching Tiger, Hidden Dragon. So the cycle hopefully will not end with a lot of hidden dragons in your balance sheet, right?
That we have cleaned up. So we have taken those 2 words off. We just focused on the crouching tiger part. We have done a lot of hard work in ensuring that we completely redefine how we look at our business. And most importantly, what we will not do rather than what we will do. Become conservative in terms of not only our risk guardrails, but just conservative in terms of everything we do. Our accounting policies, how we present ourselves in the marketplace. But that does not mean, given the size of our market we have in deposits, we are below 5%, in advances we are 5.8%. We have a long runway ahead of us. So, I can be conservative, I can be smart, and I can still grow at industry-beating growth rates without doing any stupid things. So why should we not do that rather than just say, oh, this is a opportunity here, let's just go and grab it at whatever the cost might be. So we are just trying to say that we have done a lot of hard work to get where we are. It has cost us a lot. Let's not let that go ever in our future. So it's not just about me saying it, but what institutional mechanisms you have created to ensure that you don't let go of that over a period of time. So, for example, if we have changed our accounting policies, We have changed our accounting policies in this way where it is mathematics. It is driven by formulas. Any change I need to make has to be approved by my audit committee and the board and my statutory auditors. So I cannot play around. So we've tried to create institutional mechanisms whereby, alone I can't go and make changes. The institution has to agree to those changes. And then you're going to move forward. So we are hoping that we are playing a long-term game here. And when you're playing the long-term game, there is a short-term pain which you've been going through. But hopefully in the long term it will, bear out and give us the right results.
You're the third largest private sector bank now. A lot of people say Axis Bank's ambition is to become number 2 over the next few years. So that's natural progression from 3 to 2. I've even heard people say that Axis and ICICI are like PV Sindhu and Saina Nehwal at their peak. They are raring to beat each other. Do you think you can do it? Get to number 2 in the next 3-4 years?
I made the mistake that when I joined Axis Bank, I said, I in an interview said that I've not joined Axis Bank to remain number 3. I've joined Axis Bank to take this institution to a different level. Otherwise, what is the point? I mean, I was doing quite well where I was before. So in that sense, still in that journey, still behind, very much behind ICICI. And, people...
But the gap has narrowed.
The gap has narrowed, and, people tend to define number 2, number 3 based on size. In my mind, it has to be beyond that in terms of respect and how people think of you. Size is important. It's an important parameter there, but there are a lot of other parameters. I think it's a multiple-year journey because ICICI Bank is not just sitting there and will allow us to get ahead of them. They have also very smart people, smart management team, has been around for a long period of time, great reputation in the marketplace. So we have to work harder, run faster. To ensure that we not only catch up and beat them to some extent, but this journey will continue. This, if you do beat them, you have to run even harder to ensure that you stay ahead of them. So this hard work and this visioning and this sticking to what you are good at will never stop. It doesn't matter whether I'm there or someone else, when someone else comes in. If we lose the track of what we are doing and we don't stick to what we are doing right now and continue to do it over a long period of time, even if we become number 2, there will come a stage where we'll become number 3 or even 4.
But is that your ambition?
Very clearly we want to. Why ICICI? Why not HDFC? I know with HDFC Limited merger they will become much bigger. But why should we stop our ambition at just becoming number 2? We do want to become number 1. And so one is number 1 at the bank level. The immediate step could be you become number 1 in some businesses. And then gradually, slowly, aim for becoming number 1 overall. But it's a long journey, as I said, and it is not easy. But as we have put our might behind some businesses, as we have looked at what we can do, there are businesses where we have become number 2. There are businesses where we are giving tough competition to HDFC and ICICI. And my only push internally is that ambition is the one which will carry us forward and carry us through. So we have to have that ambition and believe that we can do it. And that's what we're trying.
Okay, you started this discussion by saying that the conditions are ripe for another great banking credit cycle. But when you speak to companies, do you get the same optimism? Because, if starting from the finance minister, everybody's lamenting that somehow Indian corporates are not gung-ho yet. Are you sensing that, or is something holding them back?
So, 12 to 18 months back, you were seeing investments coming through only in certain sectors of the economy. I think you're seeing the investments being talked about in a slightly wider set of industrial sectors, and obviously India is benefiting from some of the things which I talked about earlier. But you're absolutely right that sense of that gung-ho, feeling which media seems to be talking about, or people are saying, oh, India, great things will happen. I'm not seeing it as yet. I think the corporates are still being very careful. You are seeing a lot of investments in the form of acquisitions and acquiring market share rather than investing in greenfield. Some of this credit growth which you're seeing is coming from refinance, shift of money from international bonds, international loans to the domestic market. It's also a bit of a base effect in there. And by the way, if the deposit growth does not continue, our projection says that the credit growth could taper down in the next year. So yes, you're absolutely right that somehow that gung-ho feeling is not there. It could be driven by various factors. One is this global macro. One is that they believe they're better off consolidating rather than investing because they're getting it at prices which are cheaper. So that could be the second factor. Third factor is that as people look at some of these investments, they're also asking themselves the question that should they do it incremental or they should put up large greenfield projects. So I think Indian corporate has become a bit more careful because they've gone through a crisis.
Is that a good thing or a bad thing as a banker?
For bankers, the growth is obviously much better. It's more important. But growth of the right kind. Can't be growth for growth's sake. Because if people go for growth's sake, then they will make mistakes and credits will go back. So you obviously want to back the right corporates which are going after investments with the right plan in mind, rather than just going for capturing market share. So, and I'm not saying in some sectors it's bad, in some sectors it's difficult. I think overall, almost every bank after going through this crisis has come up with their own way of assessing some of those risks. And ultimately, the risk is assessed at a group and a corporate level. It is not assessed. You look at the sector, and you might have a view on the sector, but finally, it is done at the corporate level. So you decide based on that.
You know, over the last few years, when this balance sheet cleaning was going on for the banks, everybody, all investors, liked banks which had a larger retail exposure. Corporate lending was a bad word. Now, as this cycle starts off, what will drive it? Because you've positioned yourself with the Citi acquisition on the consumer side as well. And of course, traditionally you've been strong on the wholesale side. But if you look ahead into the next 5-6 years, is it going to be a big wholesale credit lending cycle, or is it largely going to be a consumer cycle?
See, end of the day, India cannot expect to grow at a certain rate, whatever GDP growth rate we're all talking about, unless the wholesale side starts growing. I mean, in the sense that private side starts investing, and so it will reflect in the wholesale credit growth also. So this tepid growth rate which you're seeing on the wholesale side, some stage has to take off, or the GDP growth will get impacted. So we are very clear that we want to be one of the large wholesale players across the entire set of requirements which a corporate might have, and I think we are seen as one of a very, very credible banks in that story. Obviously, right now, a lot of the credit growth is coming from the retail side. And a lot of it is not only coming from retail, it is coming from mortgage and unsecured. So obviously the regulator is also and has expressed some worries that if you guys are so gung-ho on retail and everyone is going to remain gung-ho on retail, are we creating credit risk for the future? I think India that way, if you look at larger India, I'm saying let's talk about the semi-urban, the rural markets, there is a huge amount of consumption which is possible. Yes, a lot of people will ultimately take on loans or take on liabilities because from their perspective they want to raise their living standards. So there are possibilities there, and that should not be a problem. But when everyone starts rushing through the same door, and that is this great retail opportunity, some mistakes will happen. You have seen some of those mistakes play out in the fintech world, and you have seen some of the fintechs, I wouldn't say blow up, but kind of go through real crisis because they've given loans of a kind which did not make sense, or given loans to people they can't trace, or they did not have put collections in place and so they're not able to collect it. I think those mistakes will happen in NBFCs and banks also, because some of the banks are not putting everything in place before they're going through it. You cannot assume mortgage is safe because I have a asset. When you really want to go and sell the asset and there are too many of those assets, the prices you get on those assets will mean that you'll make a loss. So I think people have to be careful. Some banks have been in this business for a long period of time. Some of the banks who've been in this business for a long period of time are playing on the low credit risk side. So if tomorrow the retail side was to blow up or there was a crisis there, the tail will get impacted first. The larger banks who have been in this business for a long period of time, I think will get much less impacted because firstly, they are sitting on the lower credit risk side. Secondly, I think they've put processes and procedures in place where they're taking the right kind of credit risk. So I think you have to differentiate between where this could play out.
Now, if this wholesale lending cycle is to play out, this time the competition might be different, because in the last cycle, public sector banks were not a player. They were so badly hammered with the previous mistakes of the previous cycle, they could not participate. You just kept on getting share from them. But they seem to have cleaned up their act now. The SBIs of the world are back in the game. So how important a factor will competition be with a cleaner, leaner public sector coming into play in the corporate side?
No, the public sector banks have become quite aggressive in the marketplace. And right now you named only SBI. I'm seeing 5-7 banks which have become very, very aggressive. And the way they are playing the aggression game is to give a slightly lower price. So you have seen compression of spreads or NIMs on the wholesale side of the business. You have seen regulators and some people publicly talk about the fact that are you getting paid for the risk you're taking? And that is a question we have to ask ourselves. So right now, earlier some banks were aggressive, now they have curtailed their aggression, but some new Public sector banks have entered the space. Hopefully at some stage, NIMs will become important to them. They will curtail their aggression. And that's why, for example, in case of Axis, our growth on the wholesale side has been quite tepid. Because we believe the prices we are getting is not paying for the risk and the capital we are putting behind those assets. Why should we unnecessarily take those assets on board? We have deep relationship with those corporates. At the right price, we'll do business with them. Why should I do business with them for the sake of just doing business? So, yes, they are being aggressive. And that's what I say. Are we making some mistakes today which will play out 5 to 7 years down the line? So we might say, okay, NPL might not happen. But if you also don't price the risk well, that is also a mistake. It's not only thing NPL will not happen, but you are making a mistake. We are not getting the right return on the capital. So it is a mistake in my mind.
Speaking of competition, who would you say is a bigger competitor for you? Would you say it's the public sector bank which is cleaner now? Is it a fintech? Is it the Bajaj Finances of the world? I mean, who do you see as a bigger competitor?
So competition varies depending on which business we are talking about. I think on the wholesale side, there are about 5 to 7 banks which can actually, 5 maybe, which can provide end-to-end full suite of services. On the retail side, the competitive set is much larger. And when you talk about fintech and players like that, they are coming and attacking the juiciest parts of your business because that's where you can potentially make money. Now with RBI coming in with some regulations and very rightly so, I think the fintechs are realizing that there are only 2 ways you can play this game. One is that you come through the front door, take the right license, and then get supervised and regulated by the regulator. Or if you want to play outside the room, then you can do only certain activities in a certain way. Then you become a kind of a quasi-distributor. And you become a sourcing entity for the banks who are playing inside the room. So fintechs will remain competition. They will keep looking at what are the businesses which make the maximum amount of money for the banks, and they'll keep attacking it. I think we also ignore the fact that both the government and the regulator are also creating platforms which are making it much easier for competition to go and tap any customer. Platforms like account aggregator, platforms like where, for example, RBI has gone and completely digitized Kisan credit loans and stuff of that nature. So as either the government or RBI keeps creating these platforms which make it easier and simpler for any player to come in and play on that platform, if you're not smart enough, if you're not aggressive enough, if you're not on that platform, you could potentially see your customers going to someone else. So that's second competition which we cannot ignore. Third obviously is the NBFCs. Bajaj is one of them, but there are others also who over a period of time have demonstrated that they can play this game as well as the banks. At some stage, a question would be asked when they become large enough, like in case of HDFC, whether you become part of a bank or you continue to play the game, as an NBFC. RBI is very clearly imposing more and more rules and regulations on NBFCs and reducing the arbitrage between banks and NBFCs. And as this arbitrage goes away, the cost of doing business rises. And when the cost of doing business rises, then either you have to either look at your growth and see whether you can grow, or your margins will come down. But please also understand that lot of, for the banks especially, RBI is very, very focused on ensuring customer conduct is right. Very, very clear on focusing that IT infrastructure keeps pace with the growth in consumer expectations and demand. Cyber security has become a huge risk. And why I'm listing some of them down is to say that the amount of investment required now to play this game is also going up manifold rapidly. So when that happens, when the risks in the systems are varied, when you're seeing competition coming from fintechs and platforms and NBFCs, it tends to speak to larger players. Only larger players can manage this massive change which is happening around them. So somewhere the smaller institutions will be forced to ask themselves the question, which business do I really play in? Because I cannot play in every business. I don't have the means and the wherewithal. So I also expect intense and sharper competition in some slivers of business where the smaller institutions will try to play only that business. So competition will come from all over.
Speaking of large players, there's a new competitor coming for you. Reliance with Jio Finance. That's not a small player. It ends up disrupting any sector it enters. How worried are you about that?
We have to be. Any new player, especially a player of that nature, announces plans to look at this business seriously and come after it. And, it just doesn't add just as a finance company. They have other businesses you can feed into there, and that's why they're doing it, into the finance business. But let's understand and appreciate that it's a large market, and everyone can play in that market. The reason you will win is because you're ensuring that you are attacking the right customer, looking at, let me step back. There are two parts, two simple parts of this equation. One is that what am I doing as an institution to ensure that when a customer thinks of, he has a need or she has a need of any kind, in their subconscious mind, you have worked with that customer or done things with that customer so that when they're looking for solving that need, they think of you as a name they want to consider. So there is a huge amount of work that is required to ensure that the customer thinks of you. Now, in case of Reliance, for example, what we have seen is that they play this game of market share and the price points at which they come and attack. Somewhere in the minds of the customer, they'll say, okay, let me think of Reliance. Because maybe they're playing at their price point. So that's one part of the journey. And I'm simplifying it, don't get me wrong. Second part of the journey is when the customer actually comes to you, what is the experience you're providing to the customer so that they say, I've had a great experience with the customer. And let me give you a very stark example. For, our mobile app today is rated 4.8 on Google Play Store. It's the highest rated app in the world today. Great. Citibank is rated, because we're acquiring that business, 4.4. But if you go and ask the Citibank customers, they're not experienced access, and they think Citibank app is a great app, which it is. 4.4 is not a bad rating. But we are better. So unless the customers experience you, the value of you getting rated at 4.8 in a mobile app is only that much. Because people are not willing to experience you. So first part you have to get it right, the second part you have to get it right. Now the second part is also not simple. Because when the customer comes to you, if I understand, then I've underwritten and I understand what they will be looking for. If I can surface an experience which is delight, in 3 clicks you're out, because you've got exactly what you wanted. And if I can continue that experience across our customers, I can win that journey. Reliance has to do a lot of work to win that journey.
It sounds like a challenge, Amitabh.
It's a huge challenge. It is, because all of us are doing it, the kind of things you have to put in place to get the first part and the second part right cannot be underestimated. I'm just very gently saying that it's not as simple as it looks.
Come on, play the game and prove it first.
Yes, absolutely. And they are, the player all of us need to worry about. But that game is not easy, is all I'm saying.
What are the chances that next year Gautam Adani follows? Usually the two come together, right?
Everyone initially starts with a super app. Tatas have one. Reliance did talk about one. I think the Adanis have launched a super app. So I think it's the first step in that journey. It's not going to stop at a super app, right? If it is a super app, then you will keep adding services to that super app, and financial services is a natural service or extension of what you will do. So frankly, and by the way, they already, I think, have an NBFC. It will happen at some stage. And so we have to be prepared for everyone trying that game. You look at every large business group in India, they have a presence in the financial services space in some form or shape. So yes, we have to compete with them also. It's a matter of time.
Let me ask you a different question. We spoke a lot about the credit cycle. Where is the money for all this lending going to come from? Because 17-18% is your credit growth. Your liability growth, deposit growth is 9%. At some point, the two have to converge, right? Otherwise, where is the lending money coming from? Does that worry you?
Oh, it is a worry. And frankly, if the deposit growth does not pick up, let's be very honest here, the credit growth will be a subset of deposit growth. It can't be even at the same level. Because some of the money you have to park and put it in SLR Sierra. So, unless this is solved in some form or shape, ultimately the credit growth in the system will slow down. And that's why I said, already at least we are projecting internally, our economist is projecting, I think he's here in some of the sessions, that the credit growth will come down to about 12 to 13% unless something happens on the deposit side. I think RBI is quite clear that they have certain things to do and they are following a certain path and they will continue to stick to that path. I don't expect that to change. So I'm not expecting any major impetus to come on the deposit side. So in that sense, that is one of the worries we also have, that if deposit growth does not come back, then this credit growth will get impacted because you can't rely on external borrowings to fund that deposit growth. And by the way, even if you were to rely on it, the regulator will come down very heavily on you very quickly, saying that this is not the way to grow. Because they have to watch for the risk in the banking system. And this would create a risk in the bank if you're relying on external borrowing.
We are slowly out of time now, Amitabh, but before I end, let me ask you one question. I mean, you've had a very interesting career. I mean, from Infosys BPO to HDFC Life Insurance to Axis Bank now. If somebody were to give you $1 million today and said, buy one of those three stocks, Axis or Infosys or HDFC Life, which one would you buy?
I'm in silent period.
No, come on. You
cannot
can't
comment
out
on any stock. And by the way, if I have my head of corporate commission sitting somewhere, she's here, she will take a gun and shoot me if I say anything. Because she shot me a couple of times earlier also, and she's warned me before I entered, you will not speak. No, I mean, from my perspective, each of those industries have a huge runway for growth. It's a question of how well you can do in that runway. I mean, and where you are, what your context is, how you playing that game, given the deck of cards you have. And I would say, I've been lucky if you look at all the three names. I think they all stand out in terms of what they've been able to achieve in their industries and their sectors. I would say in case of Axis, we have a lot to do because that's where I am. And that also there represents a lot of opportunities going forward. If we can execute well, I think sky is the limit. But it all depends on how well we execute. And that's why one is working very hard to ensure that we can potentially grab some of the opportunities that exist.
Well, compliments on an excellent job so far at Axis, and I wish you all the luck in your race to overhaul ICICI Bank at number 2. Thank you very much
for
your
so
time.
Much. Thanks a lot.
Testing, yeah. Our next session, we take a closer look at banking on the economy and really the larger picture and all the factors at play currently. I'd like to welcome on stage Siddharth Zarabi, Managing Editor, Business Today Television, in conversation with D.K. Joshi, Chief Economist, CRISIL, Madan Sabnavis, Chief Economist, Bank of Baroda, Shubda Rao, founder, Quant Eco, and Shogada Bhattacharya, Executive Vice President and Chief Economist, Axis Bank. We actually have,
Good morning and a very warm welcome once again to the Banking Summit. Thank you very much for joining us, and since it's the Banking and Economy Summit, we are now getting straight up into the macro picture because it's the macro that really impacts everything, and we had a fantastic opening session that you just heard right now. Three of India's best economists, all of them very visible. Their articles and their television appearances are something that you must have seen. And we are doing this just a couple of weeks ahead of the next union budget. And it's the new year. Therefore, I'm going to start by asking this panel, starting with you, Madan, to quickly describe the state of the Indian economy as we are in the year 2023.
Thanks.
Yeah, it's good. Go ahead, it's good.
Yeah, thanks, Siddharth, and for having me out here, and good morning to everyone. Today, when I look at the Indian economy, I would say that we are in a very stable state. Now, stability is something which is very important in today's world because there is gloom and doom when we are talking of the world economy. And we ourselves have come out of the COVID times when we had a lockdown which affected our economy quite badly, I would say. And now that we have come back to a steady state growth of around 7%, and even when I'm looking at, say, 23-24, while the estimates are definitely lower than 7%, we are looking at something like 6 to 6.5% for 23-24. It still does stand out in this in the global economy. So I think that's one of the reasons why I think we can be fairly happy about it. But this said, I think there are a number of pending issues which need to be addressed. and probably we can talk about that a little
Yeah.
later. But I would say that on the whole, I think the Indian economy is doing fairly satisfactorily. And while there are lots of concern points, I'm sure the government and the RBI are also aware of it, and they will be addressed in course of time. But I would think that it will probably take another 2 or 3 years before we get to that path of 7 to 8% growth, which is something which had characterized the Indian growth path in the decade of 2010 to maybe around 2017-18.
So the key message from Madan, 2023, 6.5, even closer to 7 by the most optimistic estimates, but returning to a high growth path closer to 8%, another 3. Mr. Joshi, your opening comments.
Well, I kind of agree with what Madan just said, but I think the one of the reasons for this spurt in growth that we are seeing is that COVID is not causing any functional disruption. So the segments of the economy which were languishing, like the services, the contact intensive, they are showing a very strong growth. I think that's one of the factors. The other, I think, is we are also seeing some rebalancing of growth towards private consumption and investment. So that is also a positive sign. I think apart from that, I think economy also enjoys some structural strengths which will help it and which are helping it. And one of them is the health of the corporate sector. As per CRISIL ratings, there are 5 upgrades to 1 downgrade. So I think, and the leverage levels are extremely low, at least in the CRISIL portfolio. So that actually allows the corporates to withstand another shock, and at the same time, it also allows them to re-leverage and invest, I think, as and when the opportunity arises. So I think that's one positive. And the second is, I think this is about the banking conclave, but I think the banking sector is in a much better position to lubricate the economy today than it was earlier. So I think you have few boxes that are getting ticked, and I think this is going to help the economy, I think, withstand the next year, which is going to be a little troublesome, 23-24, and also I think it's going to help you sustain higher growth over the medium run.
Okay, so a consensus of sorts, higher growth in the medium term. Shogato, I heard yesterday that one of India's largest banks is now reaching out to large corporate borrowers and saying, do you need some credit? Now, this is just a one-off anecdotally, but I'm sure a lot of that is happening. But are we setting the stage for another boom to bust cycle in 3 to 4 years? I'm just adding that to the original question of the state of India's economy.
Yeah, so thanks, Siddharth. So one thing is, what is remarkable I find is that after 3 years, larger than that, more than 3 years, a continuous series of shocks, the kind of resilience that we are seeing in the economy, it doesn't matter whether we are going at 6%, 7%, etc. The kind of resilience that we are seeing, we're talking about the banking sector. RBI's recent financial stability report came out with very, very manageable stress levels in the banking sector. MSMEs, there is no stress whatsoever in this segment where we had initially thought there would be an emerging stress. In fact, the going is so good that I'm now worried. I mean, what are we missing? Are we missing something? Because the thing is completely on the right. I mean, everything looks good. Of course, there are big risks that will come in from the external sector because the external sector is likely to slow down. And we are already seeing in the global economy, I mean, the credit markets, the high yield credit markets, that's beginning to compress. So we are going to see some volatility. But are we missing out some risks is what is my worry. And to look ahead a little bit, what are the things? It's not a matter of growing at 6% or 7%. What are the things that we need to do to be able to sustain a 6.5%, 7% growth over a period of time?
Quick follow-up, if you could just sort of tabulate the top 3 risks, bullet points.
So, I mean, the risks are external. I mean, there is absolutely. So, in terms of a massive shock, so that's external. I mean, coming in from a global slowdown. Look, in the last 3 years, we have had 3 major channels of transmission from the global spillovers, the central bank rates, etc. One was the capital markets. We have the portfolio outflows, etc. We are mostly more or less done with that. The second is the commodity shock that we encountered, energy, metals, food, etc. Even that seems to have tapered off to a very significant extent. The third one now, which is not an immediate problem, but it's likely to be simmering over a period of time, is this global slowdown where the developed markets are likely to go into a recession, exports, which has been a big driver.
Well, I think, yeah, so you are in an environment, I think in 2022 we saw interest rate rise, but the real interest rates were still negative. Now in 23, you're going to see real interest rates become positive. So it's the financial conditions are going to tighten, as they say. So it's
Quick follow-up on that for the wider audience. When you say interest rates, will our fixed deposits give us real positive returns in 2023?
Absolutely.
Okay, to what extent?
I think that depends on how much the banks pass it on, and I think given, as the previous speaker pointed out, that there is pressure to raise deposits, I would expect the fixed deposit rates to keep rising until the time, I think, that's a general comment. But I think just to add to the risk part, I wanted to highlight that in a rising interest rate scenario, if the leverage is very high, I'm talking of global debt to GDP ratio, which is almost 350% of GDP, I think the cost of servicing the debt and the risks, I think, to some of the entities which are not used to higher cost of capital, I think is always there. So one has to keep watching out for what kind of risk can emanate when I think the financial conditions globally tighten. There is a slowing growth, your ability to service the debt is reducing. So there is, I think there is some, that's also flashing, if not red, at least yellow right now.
Mother.
Yes, Siddharth, I think there's one thing we should keep in mind. See, today when we're talking of the Indian economy doing better than the world economy, it's a statistic which I'm talking of. Okay, so 6%, 6.5%, 7%. Now, as bankers, I think one needs to be very careful because normally what we have seen in the past, we just go back historically to the last 2 decades. There are certain business phases when the economy is doing very well, bankers tend to be over-optimistic. So that's when you get very aggressive in terms of pushing the lending portfolio. The economy seems to be doing well, investment is picking up, so therefore you say, let me start lending. And you also have an interest rate environment, which is feasible, or rather it's something which is acceptable for the borrowers, so therefore people start borrowing. And that's when you run into a problem.
Likely to happen?
No, I'm just saying that today we should not get carried away by this 6-7%.
We should not.
You have to be a bit careful that in case that we don't overextend credit, because in case we do such a thing, we should not run the risk of running into NPAs later on. Just for example, we're talking of the retail segment. Normally the retail segment has a lower probability of default. That is an accepted thing. But this whole push for the retail should be followed with sound credit judgment when you're lending. So a case of saying that, look, I want to race ahead in the market, everybody is there, I want to go ahead of the others, one should not compromise risk.
Since this is a kind of a new year assessment of what is likely happening, the point that was made earlier, how would you describe the cleanup of corporate India's balance sheet and consequently the banking sector in the most sort of common sense way that you can describe?
No, in fact, I think the cleaning up of the balance sheets of banks has almost been done. And that is what gets reflected when you look at the NPA numbers of the public sector banks in particular, which bore the brunt of the crisis which we had earlier, and also in terms of the financial stability report of the RBI. So I think that particular part is all right. The only question is that we should not be repeating such kind of mistakes.
What does this cleanup mean for the Aam Aadmi?
The cleaning up basically means that if banks have been able to make the provisions, they're able to do the write-offs, whatever is required in terms of the NPAs which are there, now we say that the situation is stable. Banks should not be having this fear or any kind of an apprehension when it comes to lending. Now we had this situation when we had this NPA issue which came up, when banks preferred not to lend to the corporates, and he said, I'd rather go in and lend for the retail sector where the probability of default is actually lower. So I think this kind of apprehension is behind us.
Shogatu, taking this point forward, I want to ask you, as the Aam Aadmi here, if the balance sheets have been cleaned up, if the NPA problem has been sorted out, why is my EMI not reducing? Why is my cost of capital becoming higher? As a retail borrower, I have done my best to continue service the loan even during COVID times. Why am I not getting anything? There are no tax breaks from the Sarkar. The banking system is not giving us any leeway. Jayen to jayen kahan?
So, two things. One, from what Madan is saying, how does the Aam Aadmi benefit from the cleanup of the balance sheets, banking balance sheets? One is your provisioning costs go down. Yeah. So, I mean, that automatically, the provisioning cost is typically loaded onto the interest rates, right? The second question that you asked, that why are we not seeing a reduction? I mean, this is a rate cycle which has been so sharp. I mean, you haven't seen this kind of a rate cycle increase. And together with this now, what you heard Amitabh saying this with deposits. Liquidity, system liquidity used to be surplus of 6-7 lakh crores, not even a year back. Yeah? That has now shrunk to zero. So obviously that will show up in something, right? I mean, from the point of a monetary policy tightening is to raise rates, and that will show up in your, for the Aam Aadmi in the product. Fortunately, I think we are more or less done with the rate tightening cycle. So, I mean, slowly now, and I think at some point in time, you will get liquidity back into the system. The reason that I say this is that global spillovers that we were talking about, I mean, the rupee had weakened very sharply, and which was forcing the RBI to intervene very, very sharply. And one of the key defenses in a rupee is this liquidity tightening. So I think now we are past that stage. The rupee, we do not expect, of course, I mean, I'm not going to forecast the currency because that's a mug's game. I mean, so, but hopefully we will be starting to see an easing. I'm not saying rate cuts, etc., but we will not see this kind of tightening that we have seen in the last 6 months.
Mr. Joshi, let's take up that point. The story of last year has been inflation, not just in India, but globally. And it's been repeated, and I will repeat it once again for the audience and all our viewers who are watching us across our platforms, on Business Today, or with our media partners, Daily Hunt, and others. America has witnessed inflation which generations have not seen. India is used to inflation, and the Aam Aadmi is used to higher inflation than the privileged classes, because inflation is ultimately a tax on the poor. What is happening to inflation? Because the latest numbers also seem to suggest that perhaps the worst is behind us. Do you agree?
Well, I think the inflation did come down, and in the last 2 months, which is November and December, we have seen it below 6%. But I think I would say that I would only give 1 cheer to that, not 3 cheers. And the reason is if you take the vegetable inflation out, vegetables is the most volatile component of inflation. It keeps moving up and down. This entire decline is due to vegetable prices, vegetable inflation. If you take vegetables out, inflation is actually at 7.2%. And
just to add and contextualize it for what Mr. Joshi is saying is that the RBI sees through this data, sabzi ke bhav it doesn't account into. That means that your EMIs are not going to go down. Maybe the cost of capital may go up further. Am I right in describing it that way? You are the teacher here.
Well, no, I think the RBI will look at, I think in the last policy, they focused on the core inflation, which is taking the food and fuel out. And so I think core inflation actually went up yesterday.
But sorry, I'm contesting this point with you. Fuel inflation is being controlled by the government artificially. It's being suppressed. A budgetary allowance has been made for the oil marketing companies. Food inflation shouldn't bother us that much because you are giving a massive food safety net to hundreds of millions of people. So why is the RBI raising interest rates?
Well, I think because the core inflation part, which is linked to demand, is still high. Actually, US inflation, overall US inflation rate is higher than India, but their core inflation is lower than India.
Madan, this is something I've discussed with you like maybe for 10 years, and my point here for the entire audience, we'll also have the RBI governor later today, and hopefully he'll answer this question. Are we just looking at top level cost of capital, ignoring the reality of a complex economy like India and making money expensive for everyone, Aam Aadmi and the big borrower?
See, actually, so that let's look at it this way. The way in which monetary policy has been designed, you're supposed to target headline inflation. So nowhere does the mandate say that you'll have to look at core inflation, vegetable inflation, so on and so forth.
Why is the RBI doing it?
Therefore, as long as we are in this range of 6%, there is a certain kind of a stance which you have to take. It's not to say that in case inflation comes down to say 2%, the RBI is going to bring inflation to 0%.
Sir, but so many economists and commentators have castigated the RBI, the governor, for being a little sort of relaxed on this, saying, no, at 4% you should have hit the red light and brakes.
I think the RBI said very clearly when they kept interest rates low that their priority was growth after we had the lockdown. So they said we'll do everything to protect the economy. So everybody knew of the trade-off. You only felt that as long as growth was in jeopardy, you kept interest rates low. The moment you realize that growth seemed to be sort of steadier, and today when we take pride in saying India is the fastest growing economy, so obviously growth is better, but inflation continues to be nagging and going up, so therefore that's the RBI has taken a
So
stance
if you were the RBI
rates.
governor, what would you do in the next policy?
See, the next policy, I think we still need to increase interest rates. Because I think, Siddharth, you're always looking at EMI, you're not looking at it as a saver. Just remember, Siddharth, if you have taken a loan, you are also putting money in a deposit. You're getting a better rate out there. So I think when the RBI is there, you need to balance both the savings as well as the lending rate. And I think the RBI is also talking in terms of having a positive real interest rate. So today, when I have inflation at 6% and the repo rate at, say, 6.25%, I still have a real return of around 0.25%.
So Swagato, should I be console myself in the evening with a 25 basis point real interest rate and say, okay.
Siddharth, let me ask the audience. Home loan rates have gone up because home loans are now external benchmark linked, repo rate linked, so they have gone up by 200 basis points, right? I mean, कितने जन आप में से, many of you will have home loans. किसको effect हुआ है ये home loans के EMIs में? How much? How?
One hand went up.
How many of you are?
Oh no, more. Wait. You started something very nice. Just to add in my voice, have your EMIs gone up? Just look that.
EMIs
look at that. Look at that.
EMIs will definitely have gone up.
But how many of you ask people, everybody out here, you have a bank deposit, have your deposit rates gone up? Have you benefited?
Okay, one person is saying no.
No.
Repeat that question, seriously.
Okay. I think every bank has increased the deposit rate. So I think if you're saying that your deposit rate hasn't gone up, you've probably gone in for a wrong tenure. Yeah? The deposit rates have gone up across the board.
This is the basic problem. This problem that the rate increases have not hit any of us materially enough.
Sir, just to add to that, if 200 basis points of rate increase have not hit us materially, has 200 basis points of rate increase led to a material decline in inflation? We just heard from Mr. Joshi. I would argue that has not impacted
So that is the problem now. So monetary policy, if we take for granted that 4% inflation is sacrosanct, I have my doubts.
Why should it be? Why should it be?
So that we will appoint a new committee with Madan as the chairperson.
What would you say? No, I'm being serious. What would you say? I mean, there are very few people, and I'm very proud to say that economists are, not very flashy people, but these three people, and I followed their work for 20 years, are the finest, amongst the finest in the country. What would you do when it comes to setting
I'm not going to say that with those cameras being trained, because that'll have
No, what would it be? 5%, 6%?
My guess is, because this 4% thing, it came out because RBI...
It's a millstone around us.
So my guess is we should be okay with 5. I mean, a fast-growing economy, these numbers, the 3.3% fiscal level, etc., are meant for it.
Sir, Bharat Atmanirbhar hai for everything else except monetary policy, which is where the basic tenets have been fixed in the US, and you just copy-paste it on India.
Actually, Siddharth, if you looked at it, when the MPC had targeted 4% inflation, and one just looked at the previous 10 years, what was the inflation rate in India, the CPI inflation rate number at that point of time? In 8 out of 10 years, we were above 5%. So obviously, there were certain models which showed that 4% is the ideal rate. And fortuitously, it was an academic. That's what I would tend to believe. But fortuitously, after we declared 4%, we actually had inflation in the region of 4% for 3 years.
But not because of monetary policy commitment.
Not because of monetary policy. You see the way in which inflation is determined. Food prices don't move up or down because of RBI policy.
Yeah.
Okay, I would say that
my Saturday Mandi sabzi prices, they don't even know RBI exists, perhaps.
And today, if you look at the core inflation, see the commentaries of all the corporates, second quarter results, they're saying high input costs, we are in the process of passing on the costs. Which means, even tomorrow if inflation comes to 2%, RBI lowers the interest rate, but inflation
have gone up, costs have gone up, and not Atmanirbhar for savers Bharat, it only benefits corporates. Corporates, large organized entities are able to play the money cycle, the capex cycle and the interest rate cycle. The Aam Aadmi gets it.
Siddharth, what do you mean by corporates? Corporates तो पैसा रखते नहीं है, अपने shareholders हम लोग देते हैं, हम लोग को पैसा मिल जाता है, shareholders को मिलता है, dividends मिलता है. So I mean, whether corporates benefit, I completely agree. But the actual
explain this point, because this is what we are asked.
At the end of the day, it is we who benefit. And remember, this is what I'm trying to emphasize again and again. This is the problem. This is a huge problem for our country. people like us in this room, with this income demographics of this room, will have no effect whatsoever of this cost increases. While as the step outside this hotel, if you see the people there, they are impacted massively, massively. The surprise that I saw in this was that I would have thought that the smallest, the micro and small businesses would have been hit seriously. That is what is surprising me. I'm not surprised about this income demographics and all across the country. It's absolutely not
Mr. Joshi, you wanted to come in.
No, I think, I agree with you that I think statistically the poor faces a higher burden of inflation because they have a larger part of food, larger part of fuel, and these had been punishingly high, so to say. I think there was some cushion from the government via the food subsidy. I think that kept things under control. But I think the India's consumption basket is such that we have higher weight for food. I mean, so unlike US and other countries, so the core is a small part. That's why I think it was decided that we'll focus on the aggregate inflation. But I think the point I wanted to make was that when rates rise, I think some gain, some lose. And when rates fall, it's the same thing. I mean, people were, you were getting 5% for 1 year fixed deposit until last year, which is lower than the inflation rate. You were losing money. So now you will gain money. So it's not that it is a uniformly bad for everyone, but low and stable inflation is good for everyone in the long run. That is
absolutely, and no one can argue against that macroeconomic fundamental tenet. The idea was just to provoke a debate on this, and since we have moved into the stage where we are now talking about subsidies, whether they are institutionalized in the form of food security or the sort of ad hoc subsidy that we have seen when it comes to fuel prices, I want to turn this debate to one of the other bigger macroeconomic concerns and challenges, which I call OPS versus BJP. Now, for some of you who might wonder which OPS I'm talking about, I'm not talking about the South Indian politician. I'm talking about the old pension scheme versus the BJP. And those of you follow politics here would have realized that that has had a political impact also, perhaps to some extent in the state of Himachal Pradesh as well. This is a panel of economists. I'm not discussing politics. But this is a question I want to pose to you, Madan, and I'll go across the panel once again on this. How significant is OPS versus BJP as a macroeconomic and fiscal concern in this year? And remember, this is a year which is the pre-general election 2024 year.
See, I'll talk on it at a broader sense because I'm keeping the politics of it out. I think there are certain commitments which every government has made already in the form of, say, interest payments, in the form of subsidies, in the form of pensions. And I think we should take it for granted that that's a part of the expenditure which is committed. So whenever we talk in terms of budgeting, we'll have to talk of whatever remains from it, how best can we work with that. So rather than getting into a specific thing like saying that should we have food subsidy, should we have the OPS, I think these are more of political issues which will be sorted out. And I think whenever we look at economics, we normally tend to look at only economics. I think political economy is very important while running the government. Because none of us have skin in the game. Today we finish this lecture, we go out and then we carry on with our lives. But I think political economy actually plays a major role in all economic decisions. Because when you come to power, there are certain promises made, there are certain expectations which are there. And I think it's rightful that you follow policies on that line. So when we look at the budget, I think rather than looking at these things, we have to say overall, are we fiscally managing the budget well? Are we making the money work to the extent that we are able to do? So I think that's how I would look at the budget. So that's why I think as economists, we focus a lot on the capex part, saying that is the government doing well? Okay, there will be certain things like you may say that food subsidy is not good, I may say that fertilizer subsidy is not good. But at the end of the day, I think it's the responsibility of the government to ensure that the lower section, the lower income levels of people are actually, their requirements are there. And also since we are talking of inflation, I think if you do not give all these kind of subsidies, you do not give this kind of pensions, you do not give this kind of income, the overall consumption cycle also gets affected and inflation would be high.
Absolutely. Mr. Joshi, coming back to this point, because the old pension scheme has been described by various economists, including Montek Singh Ahluwalia, as fiscally disastrous. And just to re-emphasize this, the old pension scheme matter is not just a union budgetary matter. It is related to every single state and union territory's budget. And as we know, the state deficits are also a matter of concern, not just the central fiscal deficit. Your thoughts on this subject?
Well, I think the OPS is unfunded pension, so I think it is a pressure point, and I think there's enough evidence globally that unfunded pension schemes lead to extreme fiscal stress at some point in time. So I think it is good that we get that out of the way, and I think the new pension scheme, which is much better because at least there is funding for it. So it's like postponing the disaster. I mean, so if it may sound good to the ears, maybe good for the people, OPS, but I think from a fiscal rectitude point of view, it is an extreme stress which will show up later.
There are already 3 states, Shogoto, who are well down this new path or a return to the past, and this is not a past that we should feel happy about. It's not a glory period at all. What are your thoughts, especially because in election year or pre-election year, do you think populism will weigh on the macroeconomic balance sheet?
So, not to put too fine a point on it, to be completely blunt, I mean, the OPS will be a disaster. It's a fiscal time bomb that is ticking. Throughout the world, this is as you pointed out. You've heard of President Macron trying to reform the French pension system. This is, I mean, absolutely, there is no way to, and the problem with the OPS is it is benefiting a bunch of people that are already at the very top. Yeah? I mean, so remember that. That's not the problem in terms of subsidies. मैं थोड़ा सा time लूँगा, इसके बाद I'll shut up. So, नहीं. Look at the center's budget.
free नहीं था मेरा college था actually. फिर college.
Center's budget, 41% goes to states by the Fiscal Finance Commission rules. So of the remaining, about 40%, 42% is payments for interest. Then there are the committed expenditures, the salaries, wages, pensions, etc. That's another 20%. Then there are these quasi-committed, all the subsidies. Quasi-committed meaning not completely, but I mean you can't get beyond. After paying all of this, you do not have more than 10 to 15% of your receipts for any development expenditure. Forget the capex, तो भूल ही जाइए आप. तो वहाँ पे even for your development expenditures, you only have 10%. Is this sustainable? It's not. So now, I think to the credit of this government, I think they are shifting many of these liabilities to a more contingent liability, what we economists call contingent, the insurance-based programs, something like the ECLGS program or the health insurance, the medical insurance, etc. I think that's the way to go. To minimize costs, not have a straight outlay onto this, but make it a contingent thing so that you provide a social safety net. And people in India, for a poor country like India, you do need a social safety net. But that's the way to go about it. Okay.
Sagat, I just have one point on this. That I think the role of the state is to be a welfare state because you're looking at redistribution. So I agree, OPS and all that, one may have different views on it. I'm not getting into that particular issue. But I think, unfortunately, what's happened is that today we think that the budget should be stimulating the economy. Unfortunately, I think the economy runs primarily because of the private sector. Government is only supposed to provide some kind of a supplement in the form of whatever it can do. So I think the objective, the way I look at it is that the objective of the government, the basic goal should be to make sure that the redistribution part takes place. And you have policies that they continue.
Sorry for interrupting you. Is OPS redistribution or is it like making the fat cat fatter?
No, here we are talking in terms of, I mean, the quality of the pension. I'm not getting into that issue. I'm just saying there's a certain amount of pension. They can sort it out, which is the most efficient way of doing it. I'm not getting into that issue. But I'm saying that this issue is saying that it's a time bomb because, let me put it this way, this thing that we have a PLI scheme. Okay? A PLI is also a subsidy. We don't call it a subsidy. No, it's called an incentive.
But isn't it funded partly through export earnings?
No, it's not being funded. It's not being funded by earnings. The earnings is going to the corporate.
Yeah, so but the corporate is also paying tax.
So everything is being, whether you're paying tax or not, that's a different kind of a structure. Like, for example, if I'm giving free water to the farmers, isn't the farmer producing wheat? Why are we hammering that, saying that that's a wrong thing? So I'm saying the whole idea of the budget is that you're providing incentives to various sections of society.
So you are arguing that return to the old pension scheme is like one more layer of subsidy added?
It's another layer of subsidy. As I told you, I don't really understand the old pension scheme, new pension scheme, which is a better, because I have heard arguments on both sides, so therefore I don't understand, so I cannot comment on it. But I'm saying that getting into single items is a different kind of an issue. But overall, if you look at the ethos of a budget, you're providing incentives to all the sections, which the government is doing, either it's industry, it's farmers, or maybe it's also the retired generation.
Mr. Joshi has been silent on this, and then Shaugato to you, and we'll wrap up with a quick discussion on the budget.
Well, I think the way I would look at it is that the role of policy, be it fiscal or any other, I think is to grow the size of the pie. I mean, if you don't have growth, if you don't increase the size of the GDP, what are you going to redistribute? I think, so that is one. So I think you have to have policies which grow the size of the pie. At the same time, I think protecting the vulnerable section is very critical in this country. And I think the way it is being done, at least right now, I think you cut the leakages part. I think the digitalization has played a big role. So you will have to protect the vulnerable sections, whether it is through a safety net job scheme like NREGA, or I think a free food to certain parts of the population who can't afford. So this redistribution and growth have to go hand in hand. I think they should not be. Typically, what happens is when you grow very fast, the inequality rises. I think that's known in the world. I mean, the gap between the rich and the poor rises. So in that scenario, the role of the government is to ensure that the vulnerable sections are not left out completely.
And this includes the retired people also, who get the pensions, which we are talking about.
Okay. Okay. Shaugato, you wanted to come in, and then we'll...
Just a very brief point. I mean, beach mein economists have some benefits. I mean, this contrary to what people think. There are these, what Madan pointed out, I mean, there are different types of subsidies. Yes, the PLI is also a subsidy, but remember, for CapEx, I mean, this is where the academics come in. The growth multiplier of a capital expenditure is about 3. That is to say, 1 unit of capital subsidy or production leads to, over a period of time, 3 units of growth. For a revenue expenditure, it's less than 1. That's the problem.
Okay, that's the problem. We are in the final part of this session, and I want to turn the attention to a big macroeconomic event which is coming up, which is on the 1st of February, the Union Budget. Modinomics is Business Today's brand name for this budgetary coverage exercise. So I would request all of you who are here and those who want to check us out on our website and all our social platforms to check our coverage through this month and even subsequently. The big numbers, Madan, and I'll start with you on this. 6.5 are the two numbers that perhaps we will hear in the budget. But the question to you is, how challenging is this budget-making exercise given the overall macroeconomic backdrop, both within India and globally?
I would say that the biggest challenge is managing perceptions. Because I think the government has been very, very prudent when it draws up budgets. But the important part is what is it, how is it that we interpret it? So everybody likes to say that, will populism come in? Now, what exactly do we mean by populism? Is PLI populism? Is old pension scheme populism? Is more food subsidy populism? But I mean, that can be debated. But the important thing is that what we have seen from the government is they are committed towards moving towards that fiscal path of fiscal deficit of 4.5%. So I'm quite sure when you're talking of 6.5%, they will talk of something like, say, 5.5% for the next year, depending upon what the revised fiscal deficit number looks like for 22-23. And within that, they will do the best about what can be done in terms of managing the expenses. And we know very well that if the economy is going to slow down, the kind of buoyancy which we saw in tax revenue will not be repeated this year. So I think the GST collections have been too good to be true for last year, aided by inflation. So we're saying inflation coming down, real GDP growth slowing down. My tax collections growth will also not be that buoyant, probably maybe a single-digit rate. So I think the government will manage that. But I think the more important challenge for them is how to manage perceptions, because they have to give a feeling that they're being prudent, they're being populist, both at the same time, which is going to be difficult.
Okay, one would say that when it comes to managing perception, the Modi government and Modinomics has done a fairly decent job of that in the past years. We'll see what happens. Mr. Joshi, on that same question to you.
Well, I think you asked about how challenging it is. It is, I mean, every budget is a balancing act. I'm yet to see a budget which is not a balancing act. But this one, I think, will test the dexterity of the policymaker because, one, you are entering into a slower growth phase. Last year, we got 15.4% nominal growth. This year, for 23-24, the expectation is that it's not going to be higher than 11%. So your tax revenues will be constrained next year. So now the issue is you have been pushing capex for the last 2 years very clearly from the budgetary expenditure. How will you maintain that? The only way to maintain that is to restructure the spending part. I think that's where the challenge will come. So cut down on the unnecessary spends or trim the subsidy bill. In some cases, you can be lucky. If global fertilizer prices come down, your fertilizer subsidy bill will reduce. But my sense is that overall subsidy bill is going to be much lower than what it was last year, and that will give them some leverage to maintain.
And this is also partly aided by our decision, a brave strategic decision to buy Russian oil.
Yeah, that helped. I think so. Right now, I think so. Ensuring that you reduce the fiscal deficit, maintain your capex momentum, if not at last year's level, but at least it should be growing faster than the GDP. That's my.
What unconventional choices would you recommend that are required to be made, given that buying Russian oil when practically the whole Western world was shunning Russian oil was a very unconventional and a very brave strategic move. It could have had various consequences. Foreign Minister Jaishankar has defended that not once but dozens of times, and I think he's pretty much shut up everyone who has been critical of this decision. Are there any unconventional choices that could be made?
Well, there are very few. I mean, I think in 23 you will get lucky because oil prices are coming down, and with the global slowdown, I think the oil prices should soften. They may not soften to the extent that usually prices soften when global growth slows, and there is a China factor also, because if China recovers faster, then it's again going to push the oil prices. So I think we are working with an assumption of $80 a barrel for 23-24, which is lower than what we got in 22-23. So there will be some saving on that front. But I think there is no quick redressal of this. I mean, we have been energy dependent, we have been dependent on imports, and I think that story is going to play out. I think now the focus is gradually shifting towards how do you address the climate issues, how do you reduce your dependence on fossil fuels. That's not a one-year journey, that's a long journey, and I think I expect this budget to announce something on that, particularly to help the small and medium enterprises transition towards greener means. I think larger corporates, everybody talked about, they have cash, they can actually accelerate that. So I think some of that will also happen, which is linked to fuel in some sense, but it's a long-term story.
Many more budgets will be required.
Yes, please. Comes in, pardon me. But I think the Aam Aadmi should also know that crude oil price coming down doesn't mean that petrol and diesel become cheaper.
That's a brilliant point.
Because the taxes are not being cut, states don't cut, the centre is not going to reduce the excise duty in this difficult year. We'll have the same explanation in tough times. So therefore, we'll continue with the same kind of inflation numbers which we have.
If you've noticed, I haven't even asked the question about whether GST will be expanded to include some of the big ticket items which have been left out. I think I have lost hope, but that's a subject for another panel. Shaukat, I'll let you have the last word on today's panel and setting the backdrop for the budget from your point of view.
So, I mean, thank you. So,
just keep the mic closer.
I'm very clear that CapEx needs to be the focus. I mean, they have started the momentum. This should be like a complete drumbeat throughout the next 2-3 years. Fortunately, even the private CapEx cycles also seems to have revived. So that needs to be. मेरे लिए asset monetization, that is a very important part. So I mean, they should be looking at asset monetization and on the disinvestment side. So that's the non-tax receipts. They should actually begin to, at the lower middle levels, they should begin to cut taxes. So non-tax receipts should be the focus, and for that you need to have a fairly robust equity market. So all the things that need to be done, no surprises at all of any kind. And we are still very dependent on foreign investment. In an environment where foreign capital is still more or less shaky, we need to make absolutely sure there are not a single misstep So that the foreign capital, because global investors now, and to this government's credit, I mean, the reason that why we are in a sweet spot now is because of this fiscal prudence that the government has actually displayed during the worst periods of the COVID situation. So asset monetization, disinvestment needs to be the fulcrum for this budget together with capex spend.
Okay, Shogado, don't keep the mic there. I just want you to pick any song that's your personal favorite that will describe the economy and the budget making priorities. A tough one. I can give you time to
Madan, you start.
Okay. Madan, and then
No, actually, in a lighter manner, I'll say Pink Floyd, we don't need no education.
Okay.
I mean, I can't think of a song right now.
Okay.
It's such a complex situation.
Shogado.
सारे जहां से अच्छा हो तो मैंने that springs out automatically.
Okay, सारे जहां से अच्छा हिंदुस्तान हमारा.
हाँ, वो तो है ही है. But I'm trying to think Aradhana or something, one of those songs. So maybe you'll help. Aradhana always comes to mind when
सारे जहां से अच्छा हिंदुस्तान हमारा. I think there couldn't be a better way to end this panel. Thank you very much to our entire panel for a great debate, and to you in the audience for listening in patiently. With that, over to my colleague Abha Bakaya.
Thank you so much. Thank you, Sudha. Thank you, gentlemen, for that enlightening conversation. Our next session looks at banking in the digital age and how things are, of course, accelerating at a very rapid pace, and how banks are looking to stay ahead of the huge transformations taking place. In conversation with Saurav Majumdar, editor, Business Today, I'd like to call on stage our esteemed panelists in just a moment. In the meanwhile, a quick thank you to our sponsors today: technology partner Kyndryl, knowledge partner KPMG, energy partner REC, sustainability partner TrueAlt Bioenergy, digital transformation partner Accenture, trade media partner Media Infoline, hospitality partner St. Regis Mumbai, celebration partner Radico Spirit of Excellence, and digital media partner Daily Hunt. Saurav, if we could have you join us on stage to welcome Rajneesh Kumar, Chairman Bharat Pay and former Chairman SBI. Huge round of applause, please. Mr. Subramaniam Kumar, MD and CEO, RBL Bank. Murli Ramakrishnan, MD and CEO, South Indian Bank. And Sunil Mehta, Chief Executive, Indian Banks Association.
Thank you very much, gentlemen, for being with us this morning. And it's going to be a very, very important discussion because we have today a banking environment which has changed completely, irrevocably. And the four gentlemen who are here with me today are best positioned to talk about not just the changes, but how banks are equipping themselves and taking on these challenges from a plethora of angles. And I'll just name some of them. There are the Fintechs, which are coming in a big way, getting into the banking space, getting into the financial sector. There are the NBFCs, which are completely turning digital, almost turning into Fintechs, and we have big examples of those coming in, which are giving a major run for the money for the banks. And then there are the banks themselves, which are, many of them have very smartly morphed into almost semi-fintechs and offering a plethora of services on digital. In fact, today the smartphone is your world. The smartphone is where most of, the people are conducting their transactions, banking. And then there is UPI, the big game changer, which is actually booming. And we've had a full discussion earlier in another summit on this, how UPI and ONDC and even now with the CBDC, there are this whole troika of factors which are coming in. So without much ado, I would, request each one of you, broadly, beginning with Mr. Kumar, to give us a broad overview, Mr. Kumar, on how you see the landscape changing. Now, you've been the head of the country's largest bank, and now you're in the middle of a lot of interesting developments at a fintech, at a leading fintech. So I would like to hear from you and then from the rest of the panelists on what is the changing landscape looking like for you.
Thank you, Saurav, and thank you, Business Today, for inviting me here. You rightly mentioned that the world today and our lives today, they all revolve around a smartphone. Whatever you want to do, mobile is the solution. And in such a changing scenario where technology is all prevalent, the question about the banks, what they are doing, the NBFCs, what they are doing, and the fintechs, what they are doing. So all three, many things they are doing which are similar, but not all things are common amongst them. And each one of them, they have a certain advantage. So if I were to summarize key or broad trends, one is about technology, which I have mentioned, but the regulation or regulatory aspect of it. So there was a time when regulatory arbitrage existed between banks, NBFCs and fintechs, but not the case anymore. So if you look at what Reserve Bank has done in the past, maybe 2 years, they have removed the regulatory arbitrage between NBFCs, banks and fintech. Fintechs, they don't directly regulate, but the guidelines which Reserve Bank issued in November this year on digital lending guidelines. So it is more or less that not being directly regulated, but you are working with regulated entities and they are accountable to RBI. So indirectly you are also accountable to RBI. Then how do different entities compete and what are their competitive advantages? So banks obviously no one can beat when it comes to trust factor. It is very high. Their capability to gather liabilities is unmatched. NBFCs and fintech don't have that advantage. When it comes to NBFCs, they have done a wonderful job in terms of providing credit to that segment which otherwise legacy banks don't find it lendable. So that is their advantage. And the flexibility in terms of their HR policies, recruitment policies, last mile connectivities, that is NBFCs, but it was largely a physical infrastructure. Fintechs, they can't gather liabilities. They don't have a license to lend. But as I said that, they are playing a very critical role again in providing the last mile connectivity and through digital, not physical. And that is the key differentiator as far as fintechs are concerned. And what a bank would do to acquire a customer in terms of cost, the fintech will do probably at 25-30% of the cost. So in terms of cost arbitrage, fintechs are today best placed as compared to NBFCs and the legacy banks. And the advantage in terms of meeting the customer needs. Why they are flourishing? They are flourishing because I think the legacy institutions could not sense what the customer needs. There was a gap, and which fintechs have very beautifully filled in. So the landscape which I see today in India, our country is so huge and is still developing. So there is a room for every player, everyone. They are not exactly competitors to each other, but there is a huge scope for collaboration between all three.
Murli, I'll come to you. Essentially, all the big banks and even the smaller ones, the faster growing ones, the mid-sized ones, are investing in digital capabilities, like for the very same reasons which Mr. Kumar just mentioned, that you don't have, the option anymore because everything is now going digital and you have capabilities which are absolutely essential. How do you view this change, and do you think the mid-size and the smaller banks are equipped, are investing enough to take on these challenges?
Excellent question. Let me start by saying that I think the changes which you're witnessing today is actually the need of the hour, because if you look at the increasing demography, we are actually talking about customers who are in the age group of, let's say, 25 to 40, who are pretty much used to doing everything in digital way. So today, whether one likes it or not, I think what the customers would want is everything to be done at their convenience. Therefore, I see technology change and all this the paradigm shift which is happening in banking space or in the financial services space is, I think it's a right paradigm shift which is happening, because that's the one which is going to help serve the customers. When it comes to these changes, how a bank like ours, for example, view it, we are probably considered to be the biggest amongst the small banks, let me put it that way, because our asset size is still about 1,40,000 crores plus. When we look at it, we actually look at it as a boon, because this best way to sort of bridge the gap between a small bank and a big bank, because today technology is available to all of us, tools are available to all of us, the fintechs and NBFCs and small banks which are working with large banks, that opportunity is available for all of us. So we are actually seeing it as an opportunity, because with technology we can actually bridge the gap between a small and a large bank today. Actually, this we are seeing it very much in the market space today, because when we go and bid for a large for example, facility with a large corporate today, you find you are competing with the best in the industry today. Alongside, you are competing with SBIs or HDFCs of the world, primarily because you have technology today to bridge the gap. So I see this as a great opportunity to shift bridge the gap between the two. This is one point. Second thing which I would want to say is, today the biggest advantage for a brick and mortar office or for a large bank is the scale. And the scale comes from the distribution channel, which is basically spread across the country for a large bank, which probably may not be there for a small bank. But today with digital coming in, it's not a constraint anymore. Today, sitting in Kerala or sitting in Chennai, I can pretty much access any customer anywhere in the country. And if I can offer convenience and product suite which is comparable to the best in the industry, I don't necessarily have to have a brick and mortar. Today, thanks to technology, whether it's collections, whether it is analytics, whether it is underwriting, whether it is sourcing, whether it is marketing, everything is today available digitally. And if you are clued onto it, you can pretty much leverage any of these capabilities. So you don't have to necessarily do it yourself. Today you have everybody available with you. So if you look at the entire paradigm shift as an opportunity in partnerships, then the whole country is available for you to market. Therefore, I see this as a big change and a good change for bridging the gap between the so-called advantages of being a large bank to the disadvantages of being a small bank.
Mr. Subramani Kumar, actually Murli mentions a very important point of technology being able to then allow the mid-size and the smaller players to leapfrog into the same league almost in terms of accessing the customer. As a bank which was started off as a community bank and then morphed into this fast-growing, digitally savvy, investor-friendly bank and customer-friendly bank at RBL, what is your sense of how, do you really think that it's going to be easy for an RBL, for instance, with all its capabilities on digital, to take take on an HDFC Bank or an ICICI Bank or an Axis Bank? What is your sense?
Well, just coming to it, I'm just reminded of a very simple adage when the mobile world was expanding. Duniya mutti mein, right? They really brought the facts to the fact that now today the world is, the bank mutti mein is not the appropriate word. Banking up a haath mein, that is exactly the precise formula in which today the world is moving. It's not the question of size which matters today. It is the question of your agility and your ability to penetrate the space which is vast, wide and deeper. That's number one. The second, what differentiates today's consumer and that of the exterior consumer is their influence of the e-commerce. The ease and convenience of doing an e-commerce transaction, can it be replicated here, is a challenge this side of the table. The expectation from the consumer and the client is that, why it can't be? It again makes me to the simple analogy of another book the banks have written, Banks 2.0, 3.0. They say, do we need a bank?
Correct.
Or do we need a banking? So when you wanted to do the banking, to what extent you will be able to adapt technology is the today's, your ability to do the banking, be it anywhere in the world as Murali and Mr. Rajneesh was talking about, that's going to be the big differentiator. Second, you have to necessarily look at the today's demographic divide of the country. Forget about 9 years or 10 years, you talk about the Gen Z they call, the one who are definitely fueling today's disruptive technology for adoption wherever it is. This Gen Z, which is around 27% of the country, and you have a Gen X, which is again around 20 plus. Then you always have the people who just fit into the Gen X, the earlier who are just less than 54, the baby boomers of our age. All of them, there's a common thread which moves around is that if I can do a thing easier, convenient, most important fact today is that, do I have a cashback and rewards? What is there in for me to do this transaction? Why the payment space is extremely penetrated with all this disruptive technology is that you have ease, convenience, and you are having a cashback, and you are having a rewards. These are three facts which has penetrated into the payment. Whether it has been extended to the other part of it, the statistics prove that it isn't. Because the most important thread which is missing in that fintech and the banking world is a trust factor. Today the trust factor comes from the two facts. Do I see a building? Still 90%, one of the surveys I just read recently, which said 90% of the people whom they surveyed, and it's a very large pool of the survey, they still believe that my preferred or a primary bank or a primary financial institution, which they call the PFR, has to be the one which is going to give me a security of my data. This is a differentiator between what is the today's world of the fintech and the banking. Do I have an ability to get the trust? The trust comes from what is the negative, is there any negative news about it? These two are to be vetted, so they go to the traditional banker. So the today's world, the banks of like, we wanted to make the best of both worlds. How do we do that? You have to go to the model of a partnership. The question of me imitating and duplicating what is the efforts already done and then gone into it is not the right way of doing it. We are a regulated entity and we are bound to be a regulated entity. The fintechs are not able to, as Mr. Kumar very rightly said, you will not be able to expand your footprint unless otherwise you are able to bridge the gap of two facts of the data security and the trust factor. Since you are regulated, the best part is tie-up, partnership, and exchange the views of your trust and your ability to store the data securely and with their agility and their ability to deliver at the end. If you are able to meet the consumer expectations and consumer service to the proper customer journey, the tie-up will be able to be successful. That is something which we are wedded to and which we are working on.
So bank mutti mein is a very dangerous thing. Banking mutti mein is what you're suggesting, clearly. That's what I'm saying. So, Sunil, at IBA, for instance, what are you telling your members? How are they across the board? Because you have a very wide membership. Across the board, how are you witnessing that the trends in terms of their digital journeys? Because each one's journey will be different in terms of scale and size.
Yes, it's a very pertinent question. As a banking body, we deliberate on these issues. And the payment space is already digitalized and we are all pretty well aware of it. The next era is for digitization of the lending products and lending solutions. And I think every bank is now working on it, starting from the personal loans and unsecured loans, and then going forward. The solutions for mortgage loans may also work out because there is an ecosystem where this documentation can be done online and end-to-end journey of a lending product can happen online. So that opportunities are available. But as an industry, we are also looking for that this jam trinity has provided a lot of leverage, the way what Mr. Kumar was also saying, Subramanian was also telling that mobile muthi mein, so banking muthi mein, so jam, Jandhan, Aadhaar and this mobile trinity has really brought banking into the muthi mein. So that is there. But this has now developing certain concerns also. The concerns in the area, because a lot of people are adopted the technology, but they are not fully aware about the cyber security threats that are available, the type of frauds that is happening. And for a banking industry, as very rightly said by Mr. Kumar, that trust is the most important thing. So if the trust is lost by tomorrow, you have a digital banking and you lose your money through a fraud, it gives a wrong lesson to the consumer and to the lot of people who are associated with that consumer. So the very important aspect of working is, like, besides penetration of our digital banking, there need to be an important element of creating a consumer cyber awareness to prevent the cyber fraud. Then there is a very important need to prevent the mis-selling, because the Data Privacy Act now, the data misuse is very rampant, and a lot of institutions are going for a cross-selling and mis-selling without giving the adequate information. So the banking sector need to create certain enablers where the interest of the consumer in terms of trust is protected, so that they know that yes, if I'm dealing with an entity, my data privacy will be there, and there will not be any mis-selling, and there will need to be a governance issues to be created around it. So as a banking community, the potential for adopting the digitization in lending space is the vast opportunity, but as a you need a break with the escalator. So that break in terms of ethics, in terms of cyber security, cyber awareness, and mis-selling and all these things need to be covered. So these are the important agenda for the banking industry right now.
Mr. Kumar, I'll come to you again and I'll ask you, request you to wear your hat as a former public sector banker for a while. Tell us about, the core banking solution, CBS. That is at the core of all banks' activities, right? Now, when, Mr. Subramanian Kumar talked about e-commerce, we're talking about UPI, but the whole gamut of activities which are now digital for a bank must be putting enormous pressure on the CBS of banks. Now, how do you think banks are adapting to that, and what are the changes? How much of activity is probably moving away from CBS, and banks are beginning to do that, by the way. Even large banks are moving some activities away from CBS to ease the load on that as the number of transactions really rocket. So what's your sense on that?
Yeah, no, very relevant and very good question about like core banking. So when core banking was designed, there was no mobile banking.
Right.
It came later. And it is a back-end system. And it cannot handle the kind of data which is now being generated and the multiple channels of delivery. So apart from branch banking, there is internet banking, mobile banking, and business correspondent, what you call customer service points. Or these are the channels which are being used. And there is an explosion also in the number of customers. Jandhan accounts alone, 45 crore customers were brought into the banking fold. So this is a big challenge for all the banks. And currently the system, the way it operates is that between the core banking and all these applications, there is an intermediate layer which has been built by the banks, which is an application layer. APIs are exposed, but in terms of the architecture which banks have adopted, it is not a very efficient architecture. So now the move is toward what they call in technical parlance is hollow the core. And the core banking will just be an accounting software. And there are like different banks, depending upon what they get advised by the IT companies or the consultants. But the concept of containerization or microservices, these are the new buzzwords which are being talked about. So when you take a project of this size and imagine a State Bank of India, which has 47, 48 crore customers and crores of transactions happen. So it has to be handled with lot of care, because slight misstep and it can do a lot of damage to this system. But I think all banks, I'm presuming, that they are moving in the direction where the core banking would remain only for accounting, and there will be supplementary systems and all that, which will handle the other functions, including the mobile banking. And currently, the mobile banking is also designed depending upon the capability of the core. But now, it will have to be a reverse engineering, where you first design the front-end application which meets the need of the customer. So customer is in the focus. You provide a design on your mobile which is suitable for the mobile any customer journey, keeping the customer convenience in mind, and then work backwards. But there are solutions available, and for newer banks, this will not be a challenge. But legacy banks like SBI or HDFC or ICICI, they all will face or are facing this challenge. But we have now like the bankers who are in action. I'm a banker out of action. They may be able to throw more light on this.
No, absolutely. I think Murli and Mr. Subramania Kumar can throw some light on this whole important aspect of front end being looked at first. Because of the reasons you just mentioned in terms of the pressure of transactions, and then how the core banking solutions can be modified, upgraded. Also, and stuff being moved out and hollowing the core, like Mr. Kumar mentioned. How are both of you? I'll put it first to Murli.
Yeah, I think it's a valid question. And how we are tackling this is that the core of today banking is all about convenience of the customer. As we talked about, the target segment of all the banks today are younger population and people who are in the age group of, let's say, 25 to 40, who prefer convenience. Therefore, today, with the way you are now partnering with your various people in the ecosystem, the front end which is actually provided for acquiring the customers, that has to come with ease and come with user-friendly system, so that you are providing the best available convenience to the customer, and customer can seamlessly get through into your system. And today, thanks to many of the platforms available today, for example, if you take even product like supply chain financing or products like retail, all kinds of retail products, today you have not today, I mean, I'm talking about even for the last 2 decades, we have had platforms available where you can seamlessly carry out the entire loan cycle process in a seamless fashion digitally. Yes. Today, with the digital coming in, it's made even more simpler, because today your BRE, I mean, through your analytics, you can come out with the models which are available for credit underwriting, and through a business rule engine, you can actually seamlessly integrate with the platform. And every process in the loan cycle can today be accessed by people, which 2 decades back we used to do it manually. Today it's completely replaced with the system, the file moving in seamlessly from one end to the other. Today, with the solutions available in collection, solutions available in customer service, solutions available in cross-selling, today the whole platform can be extended far more to get into the life cycle of the customer. Today, one of the things which I think almost all the banks are now specializing in is not just looking at credit income alone. It's a non-credit income, non-interest income, which is actually playing a bigger role. Therefore, all this actually makes the entire thing very convenient. What actually is a challenge is when banks progress in their evolution, there are many legacy systems which keeps coming. How do you actually make use of the data which is residing in various legacy systems? How do you make that available for what you want to do today for analytics? That is where the big challenge is. I think thanks to the technology companies who are also focusing financial services a big sector for their growth, you more often than not, you find solutions coming from them who come and work with the bank. They pilot it with the bank, and they also sort of improve it. Improve their
And analytics is so critical, because in a competitive environment, if you do not bank on analytics and data for the same for the customer's wallet, you don't progress.
And today, if you look at analytics, it has extended not just in customer, in products alone. It has been extended to all kinds of customer journey, right from even predictive analytics, where you can look at whether a customer needs to be called for recovering your money or just a reminder sent through a text message is enough. All these actually can be culled out through the intelligence available today. And today, thanks to technology, all these things can be made available in one place. So it's made far more easier for bankers as well as for the customers. But the key thing is what our panelists said in terms of data security, which is extremely critical. And you need to have a clear firewall so that you don't misuse any of this. Not only you, the vendors with who you work with, and vendor who they are providing, who they are working with. I think you need to ensure that all of them actually adhere to the standards which are there.
We'll of course come to cybersecurity in a bit. That's so critical. Mr. Subramanian Kumar, your thoughts on this easing the core?
I'll just put it up. Now we are moving towards the stripped down versions of the core banking. Today, the core banking is not the yesterday core banking where it is the central fulcrum of every activity which is going down. That's where your technology ability comes down. You have to differentiate between the ledger posting. Today, the core banking is to be a ledger keeper. The yesterday, your Lala Ka Dukaan, if you look back, there is a ledger keeper at the back of the office. It doesn't interfere with the transaction which is happening in the front office. You strip down the operations, the one which requires a KYC of the customer, which doesn't have nothing to do with them. I'm just giving an example for the KYC. Strip it out and put it somewhere else.
Maybe the cloud? Are you using the cloud?
Yeah, cloud is one of the ways of storing it. On-prem or cloud, it depends on your budget and your costing and your efficiency to handle it. Of course, the cloud comes with its own costing as well as its own challenges.
There's the whole issue of private cloud versus public cloud.
Exactly. We can put it anywhere else. I'm just coming to the core point of that. Stripping down those things which are not going to do a transactional, going to change the ledger. Those things are to be de-stripped, virtualized elsewhere as a common thread to put the pressure, to take the pressure off the core banking. That's the way the world is moving towards. Second important thing is that today's world, everybody talks about billion transactions, the UPI and things like that. It is nothing but a movement of data from one position to another position. How the data is going to hit my core is the decision for keeping it within the core for payment solution or outside the core for payment solution. Everybody is moving towards the payment is the biggest challenge today. Should I spend high cost for doing a transaction or a relatively lower cost for doing the transaction? I take the payment gateway outside. I just put a payment bridge outside, which is going to handle a pass-through transaction differently and the transaction changing the ledger differently. It is going to bring the pressure down. So this is exactly. Then the user experience. Previously it used to be the common layer across the system. Take out the UI and UX experience out of it, put it elsewhere. The customer journey, the only one part which is going to change his balance in the ledger is going to hit the core.
Right.
So if you just draw the journey in two perspectives, number one, how it is going to optimize my services which we are offering it, making the end consumer to feel comfort. Single touch FD, double touch payment, or three-touch loan. So that will open, every touch will take you to the different segment of the layers without impacting the core banking. So the one layer of the entire consumer journey hits the core banking. The exterior core banking, exterior capacity will be able to sustain for a longer period without cutting your budget. That's the way I look at it in my point.
That's probably the way the banks are going to go. At IBA, Sunil, do you see this whole modernizing of core and, sort of relieving the pressure taking place among your members?
No, actually banking industry, right now the core is the inner strength, but most of the core is being now utilized by the APIs. The APIs are basically plug and play model on the core. So the load on the entire data, that rests outside the core, it doesn't rest on the core. That's why the core is able to take load and take so much diversification. With the advancement in technology and working with the banking and also looking after the adoption of the clouds for storage and that of the data, I think that will facilitate the system on providing more APIs to be working on the core and enhancing the capacities of the core. So this is not going to be a challenge right now because that can be built upon because the technical solutions are already available for it.
Mr. Kumar, now I would request you to wear your fintech hat. You have you were associated with one of the most big spread fintechs when you created at SBI the YONO app, the super app in that sense. Tell us a little bit about your journey creating the YONO app and how you sort of are using those learnings in your current avatar.
Yeah, so YONO was, of course, like from State Bank of India, building YONO, it was a very exciting experience. And the first decision was that normally the practice in the banking is that piche dekho, aage badho. In pure Hindi. That is how the system operates. So first break when we decided to go for YONO was that piche nahi dekho. It will be fresh. Fresh design skills, fresh this thing. Of course, the purpose was that bank wanted to attract younger generation to its. So it was like the image of State Bank was that it's not tech savvy, despite having all the technologies, but that was a perception. Right or wrong, I'm not going to that debate, but that was the perception about the State Bank, and millennials don't do banking with the State Bank. So that was the problem statement. And how it started was that we wanted to first build an online marketplace, which will attract the younger generation. But during the course of discussions, and then it was decided that we will rewrite the whole customer journeys, end-to-end digitization across channels. That was a massive project which was conceived. Initially, there were some reservations also that whether we are biting more than what we can chew, but ultimately bank decided that that's the only way forward, that we bring into fresh design thinking and which is totally customer oriented and which has no connection with the past.
Was it conceptualized as a sort of a financial superstore, super app kind of?
Yes. So as I said, that it started with online marketplace, but then decided to bring the mainstream banking into it, and as well as cross-sell products from SBI stable, insurance, travel, card. So if you look at today, it is the real financial superstore, one of its kind, where not only all the banking journeys, but all the insurance needs, mutual fund, investments, credit card, everything is at one place. And then the added attraction of online marketplace, which is the biggest hook. When the data was analyzed, most of the customers, they were spending a lot of time on the online marketplace, which has been integrated. And the design principles were also that end-to-end customer journey. And starting from, like, I'll just give you one example, and then I know that you're kidding. So the idea was that if it is, say, home loan, so it is not necessarily a home loan. Home loan everybody offers. Where do you get the competitive advantage? So it was that bank has multiple thousands of properties which are approved by the bank. So a customer would start his search from there, identify the property. He has the assurance that it is a SBI approved project or property, so chances of fraud are much less. And you start from that point till the end when the loan is disbursed, and then you have the cross-sell of home insurance, life insurance, and online marketplace to furnish your home, buy your kitchen. So that is what the concept around YONO was built. End-to-end customer journeys, fully digitized, and the experience, whether it is on internet banking or mobile banking or at the branch, identical. And just to give you an example, that savings bank, it used to take 45 minutes to set up a savings bank account. Now it takes 6 to 7 minutes. Gold loan, 1 hour. Now 10 minutes. Cash, we did the innovation where we said that we don't need a card, cashless transactions on ATM. So you know the biggest difference between the approach which bank adopted in YONO and from the past was that first time we put the customer convenience and what he needs at the design, at the core of the design. Everything was from customer's point of view. It is not that this is the product I am offering, take it or leave it. No. This was that what will make your life convenient. So that was the underlying principle, and it is today the largest digital bank in the world, across the globe. Nobody else has been able to bring out a product like YONO nowhere in the world.
That's really great. The same question, I mean, we'll come back to the whole point about, each one servicing a separate segment, though everybody is going digital in the financial sector, like you mentioned at the beginning. Fintechs and banks, the more than competition, do you see collaboration between the two sides? And I will ask the other two bankers on the panel also the same question.
Yeah, so in my opening remarks, I mentioned that it's not competition. How does a fintech compete with a bank? No question. Because in payment business in particular, fintech is beyond payment and beyond credit. They do many things in cyber security, fraud prevention, risk management. So fintech is a very wider term, but what generally we associate with this payment and credit because it impacts us the most. But talking specifically about like a company like what BharatBi does, which is in payment and facilitates lending. So in payment, there is no money. The structure is such today in the country that other than MDR on credit card, you don't make any money. You handle millions of transactions, but you get nothing out of it. So in such a scenario, and if the money you have to make out of lending efforts, then necessarily you have to calibrate with either the NBFCs or the banks. So it is not a competition. As I said, that no regulatory arbitrage, cost arbitrage is there, and capability, agility, and to be ahead of the curve in terms of adoption of technology. Their fintechs are ahead. Even if banks are thinking any project, they will take 6-8 months to implement. Fintech can implement it in 15 days or 1 month. There are reasons for that. It's not that banks don't want to do it, but there are like certain challenges in terms of size and the systems of approval and all. So I think it will be a scenario where everybody has created a certain strength. You play on that strength and complement each other. So fintechs, NBFCs and banks, they complement each other and play on your strength. And banks bring, as I said, trust, liability. NBFCs doing last mile very well at a lower cost. Fintechs doing the same thing, using technology and a much lower cost. So that is how you differentiate. But absolutely, it is all collaboration.
I'm afraid we are running out of time. So I will end this session by asking all of you, in the next 5 years, how much of change in terms of digital do you see the Indian banking space? And I'll start with Murli and then go to the rest of the panel.
No, as I'm talking, 93% of our transactions happen digitally. So it's already very close to 100. So in 5 years' time, absolutely no doubt that everything will happen digitally.
Mr. Subramani Kumar, yours.
Yeah, we are moving not 5 years. I assume that it will be less than 2 years. We will be moving towards a digitized banking, which we have already touched it. We will be achieving something called digital journey banking, where the people would like to do what is at the back end. As a consumer, I'm not concerned that whether my data is you secure it, whichever the security do it. I want the transaction to be concluded in X minutes or Y minutes. The success of the front enders is a partnership between them. That depends on how I am able to successful in making them to come repeatedly. That's where the margin gets cleared. If I'm successful in repeatedly making them to come back, if they are able to reach it, then the digital journey which has been placed is moving towards the success.
Sunil, at IBA, will digital issues, cyber security, etc., top your agenda as we move along?
Yes, it's on the top of the agenda, and 5 years from now, we can very well foresee, because India still has got a lot of rural and semi-urban areas where the outreach and issues are there. So a large section of the banking will definitely be virtual. The percentages will go up substantially. But 5 years from now, I could see that the brick and mortar plus the virtual banking model will continue and contribute, because it provides some comfort to the people at the tier 3, tier 4 cities and the rural areas to get connected with the brick and mortar system. So digitization is the way forward, but both will coexist.
And the ultimate would be when you can, using metaverse, create virtual branches, and when you interact, you feel like that you are in a branch. So that would be the, whether it will happen in 5 years or 10 years, we have to see. But that should be the vision.
But banking mutti mein, not banks, and banking mutti mein is the way forward. Wonderful panel and excellent discussion. Thank you very much, gentlemen. Big hand. Thank you.
All right, we're going to just take a very quick break for lunch. We'll be back here to continue the sessions right after that at 2:30. Look forward to seeing you shortly. You're all refreshed and set for the next session. I'd like to thank our partners, Kyndryl, KPMG, REC, our technology partner, Kyndryl, knowledge partner, KPMG, and energy partner, REC, sustainability partner, TrueAlt Bioenergy, digital transformation partner, Accenture, trade media partner, Media Infoline, hospitality partner, St. Regis Mumbai, celebration partner, Radico, Spirit of Excellence, and digital media partner, Daily Hunt. In our next session, we dive into banking and fintech and the forging of a brand new partnership. I'd like to welcome on stage my colleague Ayush Alawadi, tech editor and presenter, Business Today, in conversation with Pralay Mondal, MD and CEO, CSB Bank, S. Krishnan, MD and CEO, Tamil Nadu Mercantile Bank, A.K. Purwar, Chairman, IIFL Finance and former Chairman, SBI, A.P. Hota, Independent Director, Federal Bank and former MD and CEO, NPCI, and Sanjay Doshi, Partner, Head, Financial Services Advisory, KPMG in India. A big round of applause and welcome, gentlemen. We look forward to the session.
Hello, ladies and gentlemen. This is the most coveted time slot with this stellar panel because everyone's come with a full stomach and hopefully been caffeinated as well. If you haven't been caffeinated, it's our incumbent responsibility to make sure this is as engaging and riveting as possible. I'm not going to do that. I have a stellar panel with me. Gentlemen, thanks so much for joining us. You know, there's a classical proverb in the banking and fintech space, and I think you know what I'm going to be saying next, that banks are trying to be fintechs and fintechs are trying to be banks. But it seems like this race between, or a competition between traditional and non-traditional players. But would you agree, Mr. Mondal, that the winner is the customer?
Thanks, Ayush, and thank you, everybody. It's a very relevant question, but I think it's a little backdated, the question, because jury is out. I think no longer there is a competition between fintechs and banks. I'm in touch with a lot of fintechs. They are good friends of mine. And now there is almost complete clarity that for the good of the consumer and for the good of the country, fintechs and banks have to join hands together, because the kind of expertise which the fintechs can bring on the table and the kind of focus, the agility and the kind of governance structures they have, vis-a-vis banks have to look at a much larger, wider framework. But banks do understand customers, banks do understand the product services, and banks have a wide range of services to be given to the customers. I was just telling Ayush that most of the large banks have 20% of the customers contributing to almost 100% of the bank's profits and 80% of the revenues. So, but what fintechs does is they get a lot of customers into the banking and the credit ecosystem. So then what happens is, and then if you, we all know that already the average age of the salaried individuals in India is somewhere close to 30 and one of the lowest in the globe. And next 10, 20 years, clearly that's what our competitive advantage as a country is to the whole world. And hence getting all the, and there's a Morgan Stanley report which also said that credit to GDP on consumer side will move from currently around 55% or something like that to almost 100% over a period of time. And that can only happen when you get more customers, more consumers into the credit cycle, and that is what fintechs are helping. So in short, I can say that it's a great partnership. It is evolving. People have understood what their competitive edges are, and it's not just partnerships. It's revenue sharing. It's long-term co-opting the customers, and no longer it's who owns the customer. How do we co-opt and co-own the customers is something which is evolving over a period of time, and lots more going to happen in this.
The customer, that was the keyword from your answer, and something I want to touch upon as well shortly from now. But Mr. Purwar, you have a treasure trove of experience in the banking space. We're talking about fintech, and throughout your career, and in the early days of your career, you also worked on the computerization. I wouldn't say digitization, because I'd imagine there was a lot of reluctant participants back then in really ushering in or laying the foundation stone for the fintech revolution.
Well, good afternoon, everyone. You have touched a very, I would say, very key area. When the computerization of the bank started, particularly State Bank, in Bengal Circle, I was General Manager of Operations at that point of time. First branch computerization, the union leader comes and tells me, sir, you can computerize this branch only on my dead body. And there was so much of resistance. And when the first branch got computerized, I had to carry 250 to 300 suspension letters, duly signed, unnamed, that if anybody tried to interfere, I would not hesitate to suspend him on the spot. That kind of resistance through which computerization in the banking industry has taken place. Today, of course, a lot of water has flown and computerization is being accepted. But the most funny part I would definitely like to share with you, that after 5 or 6 branches got computerized, and whenever I visit a branch, then the union leader of that branch will seek a formal appointment with me. And after exchanging pleasantries, he would say, sir, when are you going to computerize our branch? Why? Because the kind of ease of work which happened, the way the lot of routine work was taken over with the machines, the benefits were seen by everyone. And in 6 months to 9 months, Bengal Circle became #1 in the country. So, but resistance, after huge resistance, that kind of adoption of technology I have seen in the organization. It's a huge resistance. But today, the benefits of computerization, core banking, we see, we cannot think of a banking without technology. So much so that, well, every day we come to know something new. And when I see State Bank today, they're on one single technology platform. They're not only offering banking services, they're offering SBI card, they're offering SBI mutual fund, they're offering life insurance, they're offering general insurance. So it's a very different kind of environment where we are working today. So, but with huge amount of resistance, huge amount of reservations, huge amount of that, well, it will eat up jobs. It has not eaten up the jobs. It has created newer kinds of jobs.
Absolutely, Mr. Purvar. And, you cut to 2016 and you'd already laid the foundation stone or the stepping stones for this fintech revolution, and then comes the payments push. And Mr. Hota, you were at the helm of that payments push. I remember meeting you when the NPCI was setting up UPI in 2016, and it seemed arcane to a lot of people who were also very reluctant to try this new product. How safe will it be? How different is it from NEFT, RTGS, IMPS? Is it IMPS 2.0? The questions about security. You had your fair share of questions to answer back then, but now UPI is an established product. It's been a game changer, something that India is proud of all over the world. The UPI example is now studied across the world. And just recently, we realized that even NRIs will be benefiting from this only since yesterday. What has your journey been like, Mr. Hota, when you've also had not just a ringside view, but the front row seats, the captain of the ship for India's digital payments push?
Well, all of us should be proud that India has now the best retail payment system in the world. It is admitted by everybody, some with reluctance and some are very, they admit realizing really the importance and the maturity of the payment system. But we need to also understand that our requirement is so huge. We have a lot of things to do. UPI really generating, 7.8 billion or 8 billion. It will go to 10 billion a month. But the dream is a billion a day. And billion a day is possible because you imagine the currently out of 500, 600 million customers in UPI, Actually, the active customer base is hardly about 250 million. Lot of people are not in a position to transact because they are actually they don't have money, or they need a little bit of awareness, or they are a little afraid. A lot of work needs to be done, and there are transactions which they can do digitally, build their credit profile. On the basis of that, they can get loans. Their life can be made easier. Lot of things, lot of work to do. And RBI, government, everybody admit that. So this is what I would like to say. And this UPI should not be taken just as a payment product. We also know that how UPI has triggered all the adjacency financial services. For example, the e-commerce has got a tremendous boost because real-time digital payment is possible. Because of this payment, real-time digital payments, the collections have become easier, and this payment system maturity is helping the lending space also, in collection space, in bill payments, making life easier. Lot of work to do, and I suppose without the fintechs, it would not be possible. Today we are up against arms because Google, PhonePe, Paytm, they dominate the UPI portion. Banks have taken a back seat. Banks are generating hardly 5 to 7% of the transactions, and non-banks are generating because of the customer interface. We missed the bus, but doesn't matter. Now really the banks also realize that had they continued, had they protected their turf, they would have been in a big trouble. So it is the partnership which is coming up very well, and this maturity is a welcome thing. And I suppose in all other areas also such a maturity of partnership between the banks and non-banks are coming. In 1994, Bill Gates said the banking is necessary, banks are not. At that point of time, it was very difficult to appreciate what he said. It is coming visionally, it is coming absolutely true. Banks to remain as banks, as the first question said, you said, bank to remain as banks, and technology to remain as technology, and putting their core activities, a lot of accountability is required. Banks, basic technology, obviously they need to upgrade themselves for appreciating the power of technology, and technology should know the maturity, the kind of confidence the banks have got. So with this mutual respect for each other, I suppose we are in for a very positive environment, and these most successful banks would be those who would have good partnership with fintechs. That is what I would say.
So mutual partnership, mutual collaboration. Sanjay, interesting terms, but the minute you put tech in fintech, it comes with its fair set of challenges as well. As it has grown in leaps and bounds, there are concerns as well as this evolves, and you've been tracking this space very closely. We're talking about data privacy, security, lack of financial literacy, awareness. How do you think some of these issues can be placated and addressed?
Sure. So before I go to this data privacy and the cyber part, I think let's say what the role the fintech has really played, right, and has played over the period, starting from, let's say, payments, or moving to wealth, lending, a lot of stuff which fintech players have really brought and has consumerized the banking world. So banking has always been, as you know, what I learned as a definition was accepting deposits and giving loans. And now the entire consumerization of banking has, and a lot of thanks is to the fintech world. But during this entire process, as we see historically, what are the assets of an individual? And it's always been quantified, right? The kind of money you are having in your bank account, the deposits, etc. But right now, the biggest asset which any institution sees and attaches to any individual or corporate is data. And that's where how the data is being leveraged, how the data has been managed by institutions, whether it's banks or whether it's fintech, is really going to create the entire challenge around trust. So service for any fintech or for any bank is going to be important, but trust is going to be the key. And that's where the kind of data which is getting collected by the fintechs, and now you have the digital guidelines, which also talks about the responsibility which goes on the regulated entity in terms of the kind of data which has been collected, the data which has been stored, and how the data has been used of the customer. So data and the entire leveraging, connecting, sharing of data is one risk which every institution, whether it's fintech or banks, has to really play around and manage. And the second part is the entire cyber challenges, right? When individuals are going to do transactions, as digitalization is going to pick up, as online banking, online transactions is going to pick up, how are you really, other than your data, but how is your money is also protected? We are hearing a lot of cyber frauds, right? So the kind of cyber systems, cyber security systems which organizations and institutions are implementing, that's also going to add a lot of value in terms of trust. So these are the two big points which definitely...
You know, it's interesting you say that, because over our extensive coverage with UPI, that's a question, and I have to come back to Mr. Hota for that. When you're talking about security, data theft and stuff like that, what are the kind of, for the consumer, the customer, when they're transacting on, say, GPay or on the Bheem app, what are the kind of security measures that are in place that can instill that confidence, hence build that trust and create that transparency and accountability?
In fact, on building to make the payment systems safe or UPI systems safe, all conceivable steps, all conceivable, let me not list it out, are in place. Banks, the NPCI, through the videos, through many kind of workshops, they have been doing. Each and every bank has come out with a numerous advertisement, leaflets, emails. Sometimes the customers get flooded with so much of emails, without reading they will delete. Even I also, after some time, I got disgusted. You also really would delete. So much of education is taking place. Still then, I suppose little more has to be done. Reserve Bank has also stepped in. Reserve Bank, RBI kya कहता है, really RBI is also advertising in a big way. And RBI has also now created the fraud registry. RBI has started publishing how much of frauds taking place in the payment system, related fraud taking place. So all steps are being taken, but you know, people are people. You know, they will, sharing the password. Which bank is not doing enough on that? Everybody is doing. But customers, even the matured customers, so-called matured customers, they would also easily pass on the password. They will keep the password 1, 2, 3, 4, 5. They will keep the password. They will keep the, in so many ways they really compromise. So it is a process of learning, and the task is also getting more and more difficult. Lot of user behavioral analytics and artificial intelligence is being put to the fraud management solutions. In fact, knowing the limitations of the best world-class fraud management tools, that they are limited, NPCI went for its own fraud management tool, which is superior to the best possible in the world. You know, they say that they really, we understood the limitations of the best possible 1, 2, 3, and did our own artificial intelligence and analytics, and went for that. So I suppose it is a process. We have to do that, and as you would see, from last month, RBI has in the RBI bulletin published the data about the fraud, and unfortunately, international benchmark on the fraud data is not available anywhere, but RBI is in the position, publishes the benchmarking report. I believe RBI would publish the benchmarking, India's benchmark in fraud position vis-a-vis the rest of the countries in the subsequent months. That is what I gather. So that would really build a confidence that yes, there are frauds, yes, there are cases, but still then the data, the percentage of, in terms of number, percentage in terms of value is substantially lower than other countries. That is what the analysts in different workshops say. I do not have any evidentiary, any specific data to really prove that point, but the data RBI is in the process of collecting. Let me assure you that RBI is seized with this matter, NPCI is seized with this matter, best of fintech players are working on this, so we are in a comfortable place. Security would, the fraudsters are always ahead. After Jamtara, now 3-4 mini Jamtaras have come up in the people really keep on saying that. So that we will have to really be very careful.
For that, sir, you've given us very good password tips, so the audience is largely grateful for that. But Mr. Krishnan, I want to come to you with the next question. When we're talking about this fintech revolution, yes, UPI has been a game changer, but it's not just payments. There's so much more happening. And there's one imperative, which is to make this a lot more inclusive and accessible. From the banking perspective, what kind of steps are being taken and need to be taken to ensure that?
Good, very good afternoon to one. It's a good question. In fact, if we look into, I will just take back what the first question was, that whether the banks are trying to play the fintech technology role and fintechs are trying to play. In fact, there should be a collaboration. That is what Mr. Pradai told. Absolutely, I endorse that. And for inclusive banking, coming back to the question what you asked, today what I can say is the banks traditionally have a great advantage of the trust. While the NBFCs and the fintech are able to reach the last mile, maybe with a differential cost. While the cost of the NBFC will be a little less than the banks, and fintech will be much more less. Now, if we have a collaboration amongst these, definitely the inclusive will be excellent. And while doing so, yes, as a bank, we are a regulated entity. The fintech are not directly. However, I can say that the fintech are also, in one way or other, I can say that they are regulated, particularly when it comes to the question of the data privacy, data storage and whatnot. So in turn, they are also regulated to a greater extent. Mr. Hota was also talking on the security aspect. The security is most important. Today, what happens when I talk of the inclusive, the making the customers of a small place to get a comfort that doing a transaction in the digital form is safer. One is educating him or her, and then making them to understand that doing it is safer. That becomes a challenge, particularly as Mr. Hota was telling, the password is being shared. There are a number of people who are able to lure it and take it. So that is the place where we need to work on and see that we are able to, in the days to come, definitely the collaboration has to be there. There should be a good relationship and tie-up with the fintechs, and definitely we will be able to take to the last mail.
Can I take just one
minute? Please,
one minute? On the security aspect, many of you might be aware, Reserve Bank has brought out a master guidelines on payment system security control. As many as 70 very, very specific directions are there to the banks, that please ensure that these 70 points are adhered to by yourself, by your fintech partners on the payment system aspects. And RBI is following up meticulously to see that the banking system follows these 70 data points very securely. You can see in the internet, the RBI master direction is available. This is very important. The second, RBI on computer cyber security and information audit they do. Apart from the RBI inspection, annual inspection, they do exclusively for information technology audit and cyber security audit. Plethora, and the way you would be amazing the kind of rigor with which RBI inspection takes place. You will find the best of, with full regards to the big fours also. In fact, whatever the best of auditors they will not find, RBI will find it out. Much more than that. RBI, there is no match to RBI information cyber security audit. No match. I bet you. that is the kind of really rigor and help and support that Reserve Bank is providing to the banking industry to see that the bank's computer system, their technology systems are safe and secure. So on safety and security, so much of time, attention, energy is being given by the regulator and supervisor and the banks themselves. That is what I would really emphasize, that we are really, because of this kind of supporting regulatory and supervisory supporting infrastructure, sometimes it might come as a tremendous strain on the fintech partners through us, through the banking system. But it is really making the, almost the fintechs also solid, that any turf that they go outside the country, they would be through with the regulatory and security hurdles.
Mr. Hoda, we love the confidence there, but I'm going to hold you to that bet to check what the security systems are like, because I'll tell you another example, Mr. Purva, I'd love your take as well. When there was so much talk of crypto and blockchain and how the banking, the BFSI sector would respond to that, from a lot of conversations that we had with people who'd worked with the regulator as advisors, it seemed to be largely arcane, and a lot of technologists were not seeing eye to eye. I'm glad that on the privacy and security bit that is covered. Mr. Purvar, you've seen this over the years. What is your take on this? Is there this sort of clarity, even with the regulator, about this space, especially given how the banking side originally saw fintech and now how we're talking about this mutual respect?
Well, I have seen this evolving over a period of maybe last 30 years or so. The State Bank's partnership with TCS and Wipro, Infosys started, and then slowly it evolved, and today it has reached a very different level. But I speak in a little different context. I have chaired the largest bank of the country. Today I am chairing one of the largest NBFCs of the country. And also I chair one of the fintech companies of the country. The greatest problem we find vis-a-vis the fintech companies in these institutions is that a lot of fintechs are doing excellent amount of work. But there is hardly any agency which rates them that what is the quality of their product and the quality of service and the security involved there. There is no rating system, and therefore it creates huge amount of complication on the part of the buyers to sort of, how do I outsource this, whom do I outsource this, and why should I outsource to this company? So if fintech companies can work out some sort of a rating mechanism, it would be a great help to the banking system as well as to the entire financial world of the country.
So rating system or regulation?
I would put it this way, the regulation is a little different. There will be a regulating agency which will come up.
Correct.
There are some people will get some good employment and all, so on and so forth. Not that. I would like you as fintech companies to sort of create a body which starts rating the various players, which are the AAA rated players, what kind of services they are providing, what kind of new product they are offering. There is a huge amount of demand for this kind of service today.
Mr. Mondal, something you alluded to earlier in the conversation was the customer. Right? At the end of the day, as business journalists, in the BFSI space as well, and in my previous life as a lawyer, something we thrived on was making things arcane, using fancy words. But banking is largely a customer-obsessed, customer-driven industry. You have done a bunch of things in terms of digital transformation, in retail banking, and this is a space that you understand well. How important is it to understand the mind of the customer? A lot of the stuff we've been talking about, the beneficiary of some of this digitization and payments push has been the millennial, right? 25 to 40-year-old people who are using all of these things. Now with Gen Z coming up with a very different mindset, consumption habits, how can we level up? Is it neo-banking? Is it the metaverse? Is it AR, VR? How will the banking sector now innovate to adapt to the minds of the new consumer?
Thanks, Ayush. It's a great question. So with your permission, I just move away from the payments a little bit.
Yes.
because while I am a great believer that payments is what is transforming in India and put India in a different pedestal in the world, I remember what Mr. Hota was telling 15 years back when I used to go for these global meetings. They used to say that fraudsters will not even target India because the volumes are so low there. And hence, it's not worth investing because ultimately fraudster also has a business model, right? So from that, things have changed so much today. Having said that, I just want to move away from the payments a little bit because banking is just not payments. It's beyond that. So payments is a kind of a transparent transaction which customers don't even realize they're doing when they are talking about banking. So when you come to consumers, I think what is key is to understand that and the more profitable customers in the banks are the customers who have multi-products with the bank. For example, as the digitization is happening across, and let me just take it away from payments to digitization, for example. Digitization is happening across. The government is taking a lot of initiatives, and hence the entire data and data governance bills are coming and so on and so forth. But the kind of things which are happening there will actually help banks understand customers better and service them better, and customers knowing what their rights are and how they can leverage better solutions from the banks. So from that perspective, there is a huge change. One of the big changes which I see globally and as well as in India, I was looking at some data, that digital plus branch equal to something which is much lower than a contact center plus digital plus branch, and then what it gives. So omni-channel is something which is creating a lot of change in the global space. Today you see that why omni-channel? Because a lot of pure play fintech players in India, maybe they can't do so much of banking, but globally they do. They are also moving into gradually omni-channel kind of a setup. So customers demands everything. They want digital, as you rightly said, Gen Z or millennials, etc., and they are getting into the banking space. But remember one thing, that these millennials are now moving into the 30s and 40s gradually, and these will become the core banking population of India, which will give us the revenue and the larger businesses, and they are getting digitized. Mobility platform has changed so much. Today, the mobile which I have in my pocket, I do everything out there.
Absolutely.
And if I do it, I mean, I see my children and my daughters, they do the same thing. They don't even watch movies on the TV, right? They watch it on the computer or on the mobile. So when you talk about consumers, banking is a very boring word. That just happens at the back end. But what is important is how consumers are changing their preferences in terms of how they interact with various channels, various kind of interfaces, and from there the banking comes. So clearly banks don't have a choice. The other last point I want to quickly mention is digitization and digitalization is just not about end consumers. Within the industry, within the banking ecosystem, how we are leveraging that within the banks is very important, because it gives us better cost advantages, but more importantly, the job gets more interesting and people are getting more productive. So having a productive, better, efficient organization, understanding customers, and customers have more choice, and this partnership between fintech and banks, all of it together through omni-channel and various other AI bots, we don't have time to discuss that, that's a huge subject by itself, is completely transforming. You ask the question, when you get a customer, you should know where the customer is traveling, the geo-tagging and all of that stuff gives us very different kind of data in understanding what we should talk to the customer at that point of time, so that it's instantaneous, you can give offers and things like that, and which is helpful to the customers. Same is happening on the SME side. It's just not about retail consumers. On the SME, the kind of transformation which has happened, which is 10-minute loans and those kind of stuff, Purva sir was talking about late 90s. I remember when I was in HDFC, suddenly one fine day the entire CMS model went for a toss because the entire revenue was gone one day. Then came transaction banking. But then banks figured out a way that this is basically not a revenue earner, it's basically giving services to the customer in a more convenient way by which you build a larger relationship with the customer. So I want to end saying that it's all about how do you leverage better services to the customers so that you retain that customer to the bank, And that's what digitization and digitalization and these partnerships are doing.
Mr. Krishnan, since we're on the banking perspective, I'd love to get your thoughts as well. My question remains the same. How do banks now level up and really reinvent for the new age consumer going forward? Are there particular products or services? Is the UI and the UX that important to us millennials and Gen Z? Is that something that banks should be focusing on?
Good. In fact, what Mr. Pralay said is that the digital and digitalization, I will slightly take it that the consumerism is more important. In the sense that ultimately the banks are for the customers and we should know their requirements. When we say the requirements, the UA and UX, what you said, plays a major role. Now the banks, what they have to focus is that how for the millennial or the Z Gen, how I can, what are their preferences, what is their requirements, how I can give it, how I can collaborate with the fintechs who will help me to give such a technological product which will be highly appreciated and accepted by the customers. So these are the areas where the banks need to focus today and have to have a relationship with the fintech so that we will be able to give the entire banking products to the customers as they wish.
You know, Mr. Doshi, it's interesting. Saurabh Majumdar's session was an absolutely iconic one before the lunch break. And one phrase that really stuck in my head was banking muthi mein. I think that was fascinating that's the kind of conversation we're having, and credit to this summit and credit also to the policy makers, because you've been studying this space for a while. You look at the JAM Trinity and the way it was, put out as a blueprint, but to see banks, to see this entire, the tech push as well, how much of it can we attribute to even that policy push?
See, let's not look at one policy push alone. And is it really the policy push alone which is really driving the current ecosystem? Mm-hmm. Think about it, the entire evolution of banking, as you rightly put it, computerization, right? From computerization to core banking. And then the entire technology push or policies around demonetization, COVID really taking place.
Correct.
I think doing banking at the branch or banking coming to your house, effectively using online banking. So that's something definitely as a customer and the new generation, right? That's how they are really seeing it, the ease of banking. But let's take a step back. We have been talking about a lot on fintech. Mm-hmm. I think fintechs are coming up with very different kind of propositions. There are fintechs who are pure service provider to the bank in terms of how they are really aggregating the data, and they are actually becoming a part of what the bank really requires as part of its loan journey or many other services. And that's more like a B2B. And then your B2C fintechs, which are really creating a fantastic customer experience. Many of the neo players, for example, the way they are really coming up with a different kind of a proposition, which a bank, which has really done computerization over a period of time and has got core banking, their technology stack, right, in the current way, it's not easy for them to become as agile as what a fintech is. And that's where the fintech is really bringing, that added advantage for the bank to reach out to this different kind of a customer, provide them that kind of a service experience. For example, there are fintechs who are really coming up beyond looking at payments, beyond looking at lending, but even services like accounting. So effectively a transaction going to the bank and the accounting happens automatically on its own. Now, how does a bank can really offer that, right? Now, so that's a real add-on for a bank to offer us a service, which policy definitely helps in terms of pushing some of the matters, but it's effectively what the customer is really benefiting out of it. The only concern I have, in this entire world of fintech and banking, the fintechs, they are unit economics in the business model, is something which they really need to go back and reflect. It has to be self-sustainable. For a bank to really have a fintech as a partner, as a player, if those business models are not going to be sustainable, then how sustainable that fintech player is going to be from a long-term partnership? So that's one question mark, again, from a policy perspective, as Sir said, from a regulation perspective or a rating perspective. That's one area where probably we need to really think through.
And since we're on that topic, branding, marketing aside, when we're talking about financial awareness and a little bit more about literacy, there are apps like Cred, which came about in the recent past. Do we need more such products in the space which do have a largely collaborative effort? We saw that collaborative effort with the IBA and how the NPCI came up with UPI, and it really did change the payment scene in a big way. We're seeing it with ONDC now. It could be a game changer if the Amazons and the Flipkarts are actually watching and listening. How important is it for more of these collaborative efforts and perhaps products like CRED, many more of them to come into the market to solve some of the things that you were talking about?
All products have been fantastic, products like CRED or maybe UPI. But let's again go back to unit economics. And really, putting this question in open means how much of UPI, if you see the market share, right, you have a dominance market share by a couple of players in the UPI world. Why? And again, how do you really make it sound sensible for any of the institutions from a pure unit economics perspective? From a consumer perspective, it's fantastic. From a penetration perspective, it's fantastic. So I think that's an area where newer products will keep on coming. But for a long-term sustenance of many of these newer products, we'll have to start thinking that is there some charge or some fee which needs to be really then levied. I think that's something which is important. But trust me, the kind of innovation and the kind of, the new age people, the founders, the promoters who are really coming up and coming up with their innovative products, I think that's going to continue for long. So you'll see many more such kind of transformation happening in the sector.
Fingers crossed. Mr. Purvar, I have to ask you this. Now, when you were laying the foundation stone for the computerization process, and now you're privy to these conversations as well on data, and what banks are doing with this data, what fintechs are doing, what kind of business models they're following. Is the regulator in sync with all of this? How do you view it now? And would you have fathomed or envisioned that in 2022-23, this is the conversation we'd be having in what? In a matter of 2 decades?
Well, it's a very interesting question. I have spent maybe around 50 years in the Indian financial sector now. More than 50 years, associated in different capacities. I've seen the banking and the technology evolving right from the very beginning with very small trotting steps. And today when I see the industry, the banking sector, banking industry, and when I look towards my old bank, I really can't recognize it because it is definitely not what it was. You can sit on your chair in the house, do all the banking transactions. The way in which the banking industry and the technology, the partnership which it has evolved, has helped the banking industry in a major way. I have seen a small partnership with TCS and Infosys in my time. Now there are scores of partnership which I am seeing in State Bank, between State Bank of India and different technology providers. The India Infoline where I sit, I am seeing large number of partnerships taking place where a lot of partners are adding value. And the way in which the automation and digitization is taking place, I think in next 5 to 10 years' time, we would be seeing a very different kind of financial services industry. You asked me about my vision. One of my friends talked about financial inclusion as to a lot of inclusion will take place. Today, the way in which innovative products are getting launched, the way in which the technology is getting incorporated in our various systems, and the young mind, youngsters of India who are bringing and introducing new products and new ideas every minute. Bangalore, Hyderabad, Chennai, Gurgaon, or even at some places in Bombay. It's unbelievable. And therefore what I foresee is that maybe in the next couple of years, 20 years time, maybe much earlier, that people, whatever has happened to the payment system, where a Nariyalwala accepts payment through Paytm. Tomorrow in times to come, a whole range of financial products, that is the mutual funds, current account, savings bank, credit cards, insurance products, will be assessed by each and every citizen of ours. And if you see the kind of vision which I have is that, well, in 20 years' time, we will be seeing almost every Indian citizen enjoying all host of all these perks. Will carry a credit card with him to make payments, will have an insurance to bank upon, have his banking accounts, and have the mutual funds investment. The way in which the mutual fund industry is growing, I see a very distinct possibility. So in 20 years' time, I see whole range of financial products being used by every citizen of our country.
Okay. So, Mr. Purva, in classical fashion, you have laid the foundation for our closing remarks. Very quickly, we have limited time on the timer. Mr. Krishnan, the one thing that you look most forward to as a disruptor in the banking and fintech space?
No, it's not a disruptor, I don't say. In fact, that's what I said, that both have their own roles to play. Right? So I don't look them as a disruptor. Definitely both will be able to join together and take the financial services to a greater extent in the country. That is what I look forward in the years to come. India will be looked upon by all other countries that this is the country where the digital in the financial sector is very strong.
Mr. Hota, over to you.
I suppose we have talked too much about artificial intelligence and machine learning. India has led the way in payments by innovative payment products. Similarly, in AI and ML, if in fintechs and banks in India can do something wonderful like UPI, I suppose that would help it a great deal. That would be the disruptor. So in each area, one disruption has to take place. The way in payments, the same way in banking business, in lending using artificial intelligence and ML. And we are talking too much about it. This is time to demonstrate.
And of course, in e-commerce, we have a UPI moment for ONDC coming very soon. Mr. Doshi?
I think two areas where a lot of transformation will happen by banks in partnership with agri-techs in agriculture. And second is, you've been using that word, bank in metaverse.
That's something I wish we could do another session on altogether. Mr. Mondal, closing remarks.
So I can only say disruption is this one. Okay.
The supercomputer in your pocket.
Yes, and everything is happening here. If you look at just a simple data, that how e-commerce has moved from 2000 to 2010 to 2020 to 2030, how it is going to move. 80% of the transactions will happen on e-commerce. Already numbers are in that range, and 47% of the value on e-commerce today is of the value of trade is happening on e-commerce. It's going to move to 60, 70, 80% also eventually. So, and all of that is going to happen on this. Okay. So I think this is the biggest disruptor going ahead.
Fantastic. Mr. Purva, very quickly, we're out of time. Yes, the mic, please.
One big change coming now. One very big change coming now. Technology companies now no more will sit idle with simply providing technologies. I expect some of them to set up banks in times to come. And maybe banking system will partner some of the technologies to set up future technology banks of the country. Thank you.
Fascinating points. Thank you so much for joining us. I hope you've enjoyed this discussion. There's a lot more coming up. And more importantly, the most useful tip that we got, apart from the entire evolution of the banking and the fintech space, is to not make your password 12345. Thanks so much for joining us.
Thank you. Thank you, gentlemen. Thank you, Ayush and gentlemen, for that fascinating conversation, taking forward some of the themes that we've been kicking off here at the Banking Summit today. I'd like to invite on stage Saurav Majumdar, Editor Business Today, to take forward the next conversation. NBFCs and how they've been responding with resilience. Our panelists for the next session: Ramesh Iyer, Vice Chairman and Managing Director, Mahindra Finance; Manish Shah, MD and CEO, Godrej Capital; Avinash Gupta, MD, India, Dun & Bradstreet. A big round of applause, and look forward to kicking off the next session with these fabulous guests. Saurav, over to you.
Good afternoon. And after that very interesting session on fintechs and banks, and the earlier one on digitization, we have another very exciting and interesting segment to discuss, which is NBFCs. And NBFCs, you can never, get enough of discussions because it's such an interesting sector. It's also always in the news for good reasons and otherwise. And I think we have three of the most eminent people here to discuss that. Two of them belong to storied groups, and we have Mr. Gupta from Dun & Bradstreet, and I think we'll get cut right to the chase. I think the first question I would like to ask you, Ramesh, is, we've had, I want a 2 or 3 year time frame, given the kind of, environment we are in, where banks are converting themselves into, of course, almost into fintech companies. Fintechs are getting into the financial arena in a big way. And then there is the NBFC somewhere in between, neither banks nor fintechs. NBFCs of big ones are converting themselves also into digital, big super digital players. Where do you see the next 3 to 5 years, the NBFC space? And where does an NBFC fit in the overall new world scheme of things?
So NBFCs are not new, right? I mean, we've been there for 50, 60, 70 years. And different points of times, different disruptions NBFCs have faced. I think what NBFCs have done well for themselves is very clearly identified the customer segment that they want to work with, right? And at every stage, having identified that segment, we've come out with products that suits the customer. I don't think NBFCs have played a very standardized role of saying, oh, this is what we have, please buy it. We've always designed product that suits the customer needs, and which is the reason we've been able to overcome any disruption at any point of time. And if you look at each of the NBFC, while we are all called NBFC as an industry, and you look at within the NBFC industry, you have different players doing different things, but they're all specialists in what they do. Right? And that specialized approach with a very focused customer identified customers and product designed for them is what has made NBFC extremely important, and you will therefore see our participation in the overall economic growth is going to be pretty robust.
Your views, Manish?
Yeah, I think firstly just thank you for having me here. And, let me build on what Ramesh said. Right? This is the oldest question, and in many ways, it's been this strange kind of question. 25 years ago also, the question used to be posed differently in saying, why should NBFCs exist when banks, in theory, can do everything NBFCs can? And I think just whenever in doubt, it always helps to remind ourselves, just look at it from the customer's point of view. You opened and saying there's a fintech, there's a bank, somewhere in between that is a non-bank lender. Viewed from the customer's point of view, it's just which institution delivers the best for me, for what it is that I'm looking for. So I think just like, looking outwards from some decades back on to now, what role are these institutions going to play as long as, so let's say, where we are today, I think 25 lakh crores is the sum total of non-bank lender books. There are over 10,000 of us, active, inactive, large, small. So I think a lot of it is going to be, in theory, whatever an NBFC can do, a bank can do. Whatever a non-lender can do, someone else can do. The question really is, to Ramesh's point, what are the areas you add value in? Sometimes it is looking at risk differently. Sometimes it is looking at customer segments differently. Other times it is looking at the similar customer segments, but just delivering outsized value because you're very, very focused on that particular customer segment. In some cases it would be, how do you finance a tractor? In our case it would be, how do you make a home purchase possible? And therefore, last not least, in this piece, it is about in fact, not only does the customer no longer care about, whether it's a bank, non-bank, it's about, how are you fulfilling my needs? I think it's going beyond in saying, as a customer, I no longer even care if the two of you are partnering to deliver a better promise, a better product to me. It could be a bank and a non-bank, it could be a non-bank and a fintech, it could be a bank and a fintech, it doesn't matter. What am I getting delivered, and does that add more value to me than the other alternatives?
And from an outside perspective, what is your sense of where the NBFC sector itself is heading?
Sure. So first of all, thanks for having us here, having me here to India today. Good to see lots of familiar faces. The point you made about the two doyen groups, Mr. Dunn and Mr. Bradstreet, would be a little upset about that, given that Dunn and Bradstreet's been around 2 centuries, but yeah.
I meant from an NBFC.
I know, and of course, yeah, Indian groups you said. So, no, I think from an outside in-looking perspective, I think 2 quick things, I think Manish referred to that as a user, as a consumer. First of all, there's enough to be done. So there's enough need for all segments, including the NBFCs in a big way. And I think towards his closing thing, Manish also referred to, I think the big daddies in certain segments of the market will not be able to do much without the capabilities which some of these folks bring to the table in terms of making things happen, in terms of sourcing things, in terms of structuring things. So I think there is a value, there's a role there, there's a room there, and very prevalent in what's needed around town.
Ramesh, over the last few years, we've seen a few, problem areas which NBFCs have been involved in. For instance, you've seen DHFL, you've seen ILFS, you've seen even, Shrey and others falling, and, there's been, and almost causing systemic risks to that, because of that. Now, that, as in a sense, has also given the NBFC sector a kind of a question mark, a cloud around it. I mean, there are, of course, as I said earlier, there are the very well-known ones like yourselves, but then there are these question marks around the sector itself because of the developments of the last few years. Now, how do you see that, and what are the things the NBFCs need to then therefore be wary of so that we don't repeat the mistakes of the past?
I've always believed for very long, while all the questions asked to NBFCs on the asset side, but the collapse or a failure of an NBFC always happens from a liability side. Either you've not managed your capital well, or you've not managed your liabilities well, or you've not had good governance and you've collapsed or whatever. So whenever some things like this happen, for businesses which are extremely well governed and has managed its balance sheet very well, becomes even more important to the system. So let's first get that clear to say that yes, in industry you will have some collapses, some wrongdoing, somebody not doing it well, etc., etc.
But the size and scale, Ramesh, the size and scale of these collapses have been pretty significant.
So it does bring pressure on balance sheets like ours. We are also large. Immediately there is a knee-jerk reaction that happens in the market. Sometimes liquidity can become a little more difficult to raise. All of that will begin to happen. I think those things should never scare a well-run NBFC. I think we should be fundamentally very clear as to what we are doing. Is it the right way of doing it? And have we been transparent in communicating what we are doing? I think what it reminds all of us over and over again is you will have difficult times. We have had one of our worst times in the first quarter of last year when the pandemic hit us. But will you wait for somebody to ask you a question, or will you reach out and say what has caused this? And what are those 3 actions you're taking by which you believe that things will change? And then are you able to demonstrate that what you said is actually happening? And if you do that, then you get all the benefits out there, right? Because some of the wrongdoings that we hear of and we read about, I don't think it's caused because of the business model, or it's caused because of you lent to a wrong customer or whatever. Right? I'm pretty sure people knew what they were doing was not right, maybe.
Governance, basically.
Right? So that's what I said. I mean, if you're running a financial institution, it doesn't matter whether you're a money lender or whether you're a bank. Any format of financial institution needs highest order of governance and highest order of transparency. Just a last comment that I would make. Every time there is a new regulation that gets announced, right? The question that gets asked is, oh, is this regulation little too tight? Is it too much? And I've always felt and believed that, yes, when the regulations do get announced, it's not very easy to implement them. But once you've done it well, you've taken it into your business model, your balance sheet only becomes more stronger. A quick example is we all started with NPA 365 days when I joined the industry. It became 180 days. We made noise. It became 90, we made noise. Today it is daily stamping. We made noise, but all of us have moved to that very smoothly. I think it's a question of when you look at the regulation, and we must all believe that the regulation is being done to strengthen your balance sheet. It's not to weaken your balance sheet and become systemically dangerous. When you're called you're systemically important, I think the regulator does know that there is little more room for more regulation to make the balance sheets more stronger. So I think these kind of issues that will happen with some industry, in the industry, some players, it will happen. But you should be strong enough and you should know why have you set up this business, what's the purpose, and stick to that purpose very clearly. I think you'll come out a winner.
So are you then suggesting that the common thread between them is governance issues?
I would think so, because as I started by saying, if you have a problem on the asset side, your balance sheet can shrink a little, your profits can go down a little, you could delay growth for some time, but you collapse if your liability is not well managed and if your governance is not in place. Whatever be the size of your balance sheet, you may be large, small, whatever number you want to take, you take. But if your governance is not good, at some stage you will collapse. How long will you beat that turn? You will collapse.
Manish, your thoughts?
You know, I'm amazed, Saurav, that almost every non-bank lender conversation starts with in the light of ILFS. If you total up the number of banking failures we've had in the last few decades and compare it to the number of systemically important non-bank failures, you'd see the banking column actually totals up. But rarely does a banking conversation ever start with in the light of banking failures. This happened. So strangely enough, I find that
that's probably because of the recency factor also. I mean, there's a lot of cases
I think
which have
part recency, part the backstop that just comes automatically with banking failures.
Correct.
But to that, I mean, that apart, I think the one thing at the core, it's, you know, like you mentioned, storied groups or governance. I think some of the challenges are embedded in the question, why did you get into this business in the first place? In the decades gone by, we did, as you know, like you mentioned recently, one of the things that I think regulatorily we've gotten into a much better place now is that regulatory arbitrage used to be a good enough reason to be in this business. You know, banks can't do this, so as a non-bank we'll do this. They don't do this, that's why we can get into this space. If that is going to be a reason for you to be in this business, you're dead on arrival. And I think that's been plugged. Thereafter, a lot of some of the, the failures are quite basic in nature. In the sense that, we talk about ALM, or we often sort of throw about more complicated sounding stuff. It's just that if you're going to give a 15-year loan and you borrow for 2 years or lesser, that's just ALM built in right there and it's going to pose a risk at some point. Last not least, corporate governance says any entity at certain scale and above is going to be front and center. It has nothing to do with just financial services or lending or liabilities. Any business with corporate governance or, just put differently, a complete mismatch on what your business stands for versus how, you as owners of that business make money. So 3-4 of these things are quite basic. And I'm quite glad that just in general, regulatorily, just in terms of all of the, law, whether in letter or spirit now, just pushes all of us in the same direction, that if you're in it for the right reasons, you're going to have to think long term. And whether, the nomenclature or your entity is called a bank or a non-bank, if as an institution you're an important part of the financial system, these rules are going to apply to you. And, if it works for you, be in this business. If it doesn't work for you, don't.
Avinash, you think that the essential, like they're saying, essentially it is bad governance and just a bad way of running a business simply, which has caused these failures?
I mean, I won't comment on the specific things, but I think, that's a pretty good reason why most failures happen globally, not only in the financial services sector, but outside the sector as well. So, just looking back at my own kind of career, I worked in a bank, big banks, and then moved to work in a big four. And then I did some private equity, and now I run Dun & Bradstreet. Now, when I look back and talk to my colleagues, I mean, the level of governance, the level of regulation which you see working in a HSBC or a Citibank, and then to a big four, which also is kind of regulated. I did non-regulatory work. And then a private equity, which is just about, doing the deal in many ways and making sure you make money. And on Dun & Bradstreet. So, I mean, the oversight is great, it's good to have, and especially when you're dealing with the large systematic players here. So I think, the consolidation as a nature of business, as of industry, that's bound to happen as the whole ecosystem evolves and matures. So nothing wrong there. I think failures, bad apples are everywhere. They need to kind of get rotten someday, which has happened in some cases. But that shouldn't be the point of starting a discussion or starting an outlook on any sector or any industry. And I think you have bad players everywhere, you have good players everywhere. You choose who you want to do business with, and you choose your partners carefully, hopefully when you learn lessons, when you see things go wrong.
That's right. Ramesh, regulatory arbitrage is a point which we were discussing just before the session. I was discussing with Manish. And like he rightly says, that cannot be the reason why you get into this business. This business has to make sense for you as an NBFC player. Now, but as regulatory arbitrage shrinks, the differences become very, very low, less in terms of regulation. What is the kind of challenge which an NBFC will face? And I'll come to some of the newer players who are coming in. That discussion I will come to later. But at this point, what is the outlook you see as far as regulatory arbitrage is concerned?
We started off with that discussion, right? NBFCs have created space for themselves. I don't think the NBFC as an industry asked for this gap to be maintained. They were existing then. And over a period of time, they have shrunk, right? NBFCs are built around customer-centric models. We've reached out to customer, understood their needs, designed a product for them. That's what we started off with. So these arbitrage shrinking, is it going to create a problem for NBFCs? My personal view is no, because the models are not built on that to say, like we had the earlier comment, where if the profits or the margins were made because of these arbitrage, then yes, you have a challenge there. But they were available incidentally. I don't think the models were built on that, right? And therefore, we have to very clearly recognize that if you can raise 3-year money, do 3-year lending. Don't do a 10-year lending and imagine that you'll make money because of that, right? So I think these are all very specific, specialized models where we know how to lend. And then if you look at really NBFC's model, while we do a lot of things on the lending side, but they are all very strong recovery-based models. And there is no arbitrage, right? It's a business model outcome. And that's the reason we're very successful on the retail side. So as an NBFC, if I go and do a lot of wholesale lending, we could have a different problem. And likewise for a bank, it could be very different. If you were to do a lot of retail and you have to go out and physically recover, you could have a challenge. So we have to recognize the strengths of NBFC and then build a model around that, rather than imagine that arbitrage will help you to succeed.
Manish, your thoughts?
And if I can just switch that a little bit, because, not much to add to Ramesh's points there, I think. So if we just move arbitrage as a much more of an old world advantage and look forward, the less we, and increasingly, and we are a new player, we are only 2 years old. And where, so what you're not excited about is that there's a different set of rules for banks, different set, forget that. From a customer point of view, what we are most excited about, and lots of people here in the audience are people who work in financial services, small business, is what we are most excited and the largest opportunities in partnerships. Let's take a couple of examples, right? One, we're very comfortable as non-banks where we may borrow from a bank. In some cases, we will partner to deliver better value to customer. In some cases, we'll compete. against the very same institutions that we borrow from. But very, very often what tends to happen is there are different parts of the puzzle from a customer's point of view. You can put it well together. For instance, you want to underwrite faster than anyone else has done before. The way you're going to be able to deliver that value is half of that actually you're going to partner with someone who does it better than you. How do we authenticate a customer? How do you quickly digitally pull all of the docs that can then allow you to underwrite, get a one view going? All of those are by partnerships that you don't build yourself. From a customer's point of view, however you're delivering real value, it may actually be 3 different institutions coming together to deliver that. Go further even. Not every asset, the originator is not always the same as the balance sheet provider. Again, if we're going to grow this market together, earlier we spoke about the need. Let's just take a little bit of perspective. The US is what? About 6 times our size as just India, GDP to GDP, right? There are 4,000 financial services players, just lenders alone in that market. It's, if you go past 100 in India, you're hard pressed to come up with names. So, it's a myth that it's overcrowded and lots of people fighting over the same customers. And therefore, the opportunity is not so much assume that regulation is given. Do the right thing, whether the regulation is out there already or it's going to come. If it hasn't already come, it will. And look at saying that if A plus B and C between us, if put together there's better value to be created, we'll just grow this market that much faster, because nobody is going to go as we are from, let's say, 3 trillion to 5 trillion and 5 to 10. That delta that's going to come is going to come via partnerships. We don't have to worry about saying regulations will loosen and then we'll grow.
And the stage at which India is in, there is enough to be had in terms of partnerships as well. I mean, it's not
Absolutely.
just a competitive
Absolutely.
landscape alone.
Yeah.
From a Dun & Bradstreet perspective, I mean, how do you see this whole change in terms of the regulatory arbitrage shrinking, and like they both agreed on, that is not really a challenge. It's how you, sort of collaborate if necessary to get the best value to the customer. How do you see it from an external perspective?
I think the way to look at it, as Manish said, is, there is enough to be done. The regulatory framework will do what it continues to do, which, and those agendas also are quite clear. But as a person operating in that environment, you've got to manufacture some growth for yourself. And if the economy is growing at some rate, you've got to grow at some multiple of that. And the best way to do that is to focus on the market, and possibly through partnerships, possibly through better integration with data providers, and all of that, which is all available to the entire ecosystem. So I think the regulatory arbitrage, the overarching framework will always remain. I guess every country has it. India will have it in some shape or form as well. But because there is enough to be done, I think there will always be room to grow and provide that service to the market.
Ramesh, we spoke about, you talked about, giving customized solutions for the client. Now, banking and the financial sector broadly, if I may use the word, is getting commoditized in a sense. Like a lot of people are looking at similar products, technology becoming a sort of common theme across the board. How do NBFCs then, are you then suggesting that each NBFC should then look at a niche or a few products which it can then excel in? You seem to suggest that.
If you look at today within NBFC, we are all specialized in our own way. If we were to talk of us, we are very specialized by geography. We want to do a lot of work in semi-urban rural market. Right. There'll be someone else who will be very strong in a pre-owned vehicle. Some will be very strong in personal loans. So already that specialization has happened. I think what I'm also trying to let you know is, while all this is getting commoditized, we have to become solution provider. And the solution is not just while lending. I mean, we go through it all the time. If a monsoon fails, you need to provide a solution to your customer, give them some more time, partner them if you have to recover your money. I think the NBFC model is by nature built that way. Even if you look at money lender on the other extreme end, not regulated, but he's also in the lending business, his only success is he's able to provide solution to someone's problem. Right? I think the NBFCs are very specialized in understanding needs of the customer, either while lending or while recovering.
But that's what banks also are saying, you know, they are also going to the last mile through technology and otherwise.
But the
trying
fact
to
remains that everybody is not getting credit easily. And therefore there is a customer for every entity out there. Right? How deep is the credit penetrated? Today we are present in 400,000 villages of the country where we have customers. But if you ask me, in every village, is every customer has been given credit? The answer is still no. So that's how microfinance is able to do for one segment of customer, different NBFCs, and they are all specialized. You take the regional NBFCs, they are so specialized. They know everything about the area where they operate, and therefore they are super successful. So if you ask me, there is a very clear solution in the minds of every NBFC in the segment they are operating in, and they are willing to live that life and partner with the customer to make it a success.
Manish,
Yes, Saurabh. And again, the question you ask could be asked of any business, right? There is a market, there are an existing set of players. What is your right to win? You're absolutely right. I think sometimes it's a bit of a misnomer that banks can't do last mile. There is no way you can match all of the PSU banks collectively in terms of geographic split. But I'll give you two examples to make the point. If all we allow ourselves to be judged on in who's going to give the cheapest loan, we will die. There is no opportunity for us to work. Two examples. In our housing finance business, we define our goal as saying there are a bunch of elements that will go into someone choosing us or not, but the problem definition is not whose is the cheapest loan. The problem definition is, why is the person not buying a home? What role can we play to help buy that loan? Sometimes it has got to do with product design, which is you allow for unequal payments instead of just the same standard payments, because people have cash flows to manage. You have to sell one home, get into a new home. Can you facilitate resale? If the problem definition is help the person buy the asset, buy the home, you will come up with solutions which don't always just rest on saying everybody does this, I will undercut it by this. Second, which is the bulk of what we work on, is on the SME, especially on the MSME side. Very often, lending is one of the things you need to do to enable that business growing. What else? And that therein, I think, where conglomerates like, ourselves can come in and play a role in saying, if whom you're lending to, if their business grows, if their ventures flourish, A, they become more credit worthy. Second, credit demand gets created from business growing. Credit, you don't want credit for its own sake. Nobody ever woke up in the morning saying, today is a great day to borrow. It is about saying, if this was possible and I've got avenues to earn more money from where I invested than in what it cost me to borrow. So these are just two examples where, again, the nature of the entity doesn't matter. A bank can do this, a non-bank can do this, two guys partnering can do this. Are you adding value to, are you just making that particular asset productive? Therein lies the answer in saying, then do we have the first right to become the financer of that asset?
But just coming back to our original discussion on the problem areas, do you think, and I need to ask this of both of you, in terms of pedigree, because you are backed by a Mahindra group, very, very respected, you are at Godrej, do you think that will also have a sense of kind of stability and calm for the client and customer?
So from our perspective and, seeing from the last 2 years, we definitely think so. And not for any other reason. I think some of the challenges that people faced as consumers, specifically in saying that there is a going in pricing and, what does your reputation mean to you? And therefore, only one part of the equation is what are the terms of, financing when we went in? Because these are all variable loans, what will it become a year from now? Can I take your word for it? So I do think it plays out in two ways. Without a doubt, speaking for ourselves, without a doubt, just what the group brand stands for is important to the consumer. And it puts a responsibility on us in saying, I have these expectations of you, you better deliver to them. The second is institutionally, to Ramesh's point, a very large part of us being successful is going to depend on how we manage our liabilities. But access to those liabilities, at terms in which you can then compete with players is important, and coming from the sort of parentage we have is certainly helpful.
Your thoughts, Avinash?
I mean, I think the differentiation, I guess there's been enough talked about that. I think maybe you are leading up to that as well, because I was not here for the pre-chat you guys had, is the differentiation which is, as an outsider, as Dun and Bradstreet, and I guess most of us here see from the outside what's happening in some of the NBFCs. We met an NBFC earlier this week, not even a large NBFC, and I was surprised that they had 147 people in tech and they had 45 people in data analytics. I mean, that kind of differentiation which seems to be happening in the business is quite remarkable, that, the amount of investment, the amount of investment not only in technology but just in software and hardware, which folks are putting in terms of getting those niches or markets where they want to operate or be so good at it that, they're able to do a lot better in terms of finding the right customer and then collecting better and then, having the right kind of credit quality. That, I think, is going to be the big differentiator as an outsider. The market will, I guess, keep pushing folks who provide capital to wherever the needs best are.
No, it's a very valid point you make, and I want to ask this of Ramesh. In an earlier panel discussion on technology, one of the smaller sized banks he was talking about the fact that today, if you invest in technology, you actually are a bridge between the small and the big. You can sit side by side with the biggest bank and offer the same facilities to the customer because of use of, the access to the customer becomes easier. So how much of technology is going to now drive NBFC in the coming days?
I mean, gone are days where we can believe that we will do everything by ourselves, right? So you need to recognize technologies two ways. If you're going to partner with anybody, they expect you to be technology ready, otherwise they don't want to associate.
That's right.
Right? So therefore, your readiness towards that is a must. Two, if you're going to grow in size, it's not possible to manage large size unless you have adequately and appropriately invested in technology. Two. Three, if you have to deliver services to your consumer wherever they are with speed without sacrificing on any of the quality parameter, technology is a must. I mean, why we even have to discuss that? This has become one of the key enablers to success of any business. As much as treasury is as important in NBFC, I think technology is sitting in equal ground there. It's no more just playing a role of control and MISs of the world. It's a decision-making tool almost. Right? And therefore, not to look at technology on a standalone basis, look at the quality of the data that you have, and of course, add to that the knowledge that the institution possesses about the business. You put the three together, you create a magic out there.
Manish, you said a little while ago that Godrej Capital is 2 years old, one of the newer players, and then there are very old and very well-established players already in the business. Now, what do you think has driven players like Godrej, the Poonawallas, Vedanta, Adani's, and now you have, we will come to it probably as a separate question, the Jio entry coming up. So what exactly is what is this that you see in this business that has driven a group like Godrej to come to the business?
So speaking for ourselves, I think a few things. One is I think generally from a macro perspective, consolidation and polarization sort of played out in various businesses. From the group's perspective, we saw it in our real estate business and felt that a very similar macro was playing out. Because again, regulatorily, from a capital allocation perspective, it's all moving in the direction and saying there's no magic 3 to 5 year period in which sort of, you're going to be able to release your money. You're going to have to think multi-decadal. So it plays to the strengths of the larger groups that can, set aside capital, set aside time, and just allow for the runway. I think what's common to, some of the folks that you spoke about, where, people like us getting in say this is our right to win, is just one, what the brand means to the consumer. 10, 15 years ago, the lender's brand didn't seem to matter as much as it does today. Today, whether, you're taking money or you're giving money, what the brand stands for is important. Access to capital, willingness to deploy it, access to liabilities is an important ask. And I think one which is an underspoken about fact is access to customer ecosystems. that allow you to get started, demonstrate your value to an existing ecosystem. So for example, in our case, if we build when we start with a housing finance business, you first look at customers buying from the group and then expand elsewhere. When we build a supply chain business, when we have an agri ecosystem, we have consumer products ecosystem where you look at innovating within the ecosystem, showing value and then going outside. So I suspect it's a common, that's similar, where as groups get in and saying there's now a competitive advantage in coming with these and just arbitrage isn't a reason to do so, which is why I suspect you see these are certainly big drivers from our perspective.
Yes, please. The NBFCs or financial institutions, whatever, they have to come and expand the market. Always this question gets asked as though the market is going to remain of the same size and more players are going to come and compete there. If that is so, we would never have come up if the banks were there and they were to do what they were doing. Whether the OEMs accept or not, we believe that as NBFCs, we have expanded the market. We've created more consumers. We talked about your ability to understand the need and provide the credit and therefore encourage them to acquire an asset. So more players will come, but why will they want to do the same thing that all of us are doing? They'll come and do something else. They'll come and do something more. And you'll see the market expand.
That's actually true. Nasha, I want to ask you, as RBI is nudging bigger and bigger NBFCs to convert more or less into banks in some form or the other, how do you see that play out? Do you see that happening more and more, or do you see NBFCs becoming bigger but content to be in their own space?
Sure. So just before I answer that, I'll share an anecdote on the tech side, because we were talking about tech. I had worked in Citibank where everything was to be done differently and everything had to be outsourced, and tech was a big kind of partner. And then I moved to HSBC in London that time. I was in banking, investment banking, and that time TCS was thinking of an IPO. So I took Mr. Ramadurai to see Sir John Bond, who was the chairman of HSBC. Then HSBC never outsourced anything at that point in time. Now it's different. And they used to spend something like 3% or 4% of sales on tech, which was a very large amount. So Sir John Bond told Mr. Ramadurai that, Mr. Ramadurai, tech is not the tail, tech is the dog. I remember those words very, very clearly. Banks that time, banks like HSBC, that tech is all in-house, we don't outsource tech, we do everything ourselves. And how the world has changed for everybody from that point in time. So I guess things will keep evolving. I think that's what we are saying on the tech side. On the NBFC, RBI, regulatory banks, that's a debate way above my pay grade, I would say. Those things are you can say things which will maybe right, maybe completely wrong. But I think, in terms of where the regulator sits, the regulator is doing its job, his job, in terms of, how do you make the market more, rule out all the issues which have happened, the failures which have happened. So I think they're just doing their job from their point of view. I think from where I sit, from where all of us sit, possibly there's enough to do. There is a need, as we've said, for players like the NBFCs, there's a need for the banks. So I think both will coexist and hopefully harmoniously, and the regulator will allow that as well.
Ramesh and Manish, one last question before we wind up on the advent of Jio. How do you both see it as the Jio Financial Services gears up to get into the scene in a big way?
Well, at this stage, we can only say we'll partner and work together, don't worry.
Manish?
Yeah, look forward. So far, very rarely have new entrants come and, in most cases, markets grow. And therefore, there's plenty for us to look forward to.
So, as a customer, absolutely. Yeah, as a customer, absolutely.
Correct. Hate to disappoint with an uncontroversial answer, but genuinely look forward.
No, it's a fact that market will grow. It will not remain stagnant. And on this optimistic note, Ramesh, I know that you have a hidden talent, which I think we need to, get something out of you in terms of you're a great singer, and you have said this yourself. And I think, this you are within in the community of bankers and financial people. So as the NBFC, one of the key players in the NBFC, what is your message through a song? Let's hear it from you. I know you are a very good singer, so you can't deny that.
I'm going to send you a debit note for
Please, most welcome. No, but seriously, I mean, as to enthuse the sector, what would your message be?
Questions were about yesterday. One of the oldest song is छोड़ो कल की बातें, कल की बात पुरानी, नए दौर में लिखेंगे मिलकर नई कहानी, हम NBFC.
On this very optimistic and musical note, thank you very much, gentlemen. It was a pleasure, absolutely.
That was definitely one of it.
Thank you, gentlemen, and for that surprise teaser at the end. Our next conversation is on sustainable finance in the green economy. The challenges, the opportunities, the growth and excitement, of course, in the sector, along with the key risks as the world battles with the climate change agenda. Siddharth Zarabi, Managing Editor, Business Today Television, in conversation with Ankur Khurana, Managing Director, Corporate, Commercial and Institutional Banking in India, Standard Chartered Bank, and Vineet Rai, Founder and Managing Partner, Avishkar Capital, on stage with us. Over to you, Siddharth.
Thank you so much, Abha, and that was a wonderful session. I'm going to request the people right here up front to help us clear the hall as we get the next session up and running. If you can help have our colleagues get the hall cleared up. Thank you, and a very warm welcome once again to this Business Today Banking and Economy Summit. The session that I have is not an easy one to do, but I'm glad that I have two people who are native to this in some sense, experts who have spent time doing this, and I really want to use this opportunity when we were talking off stage to get to understand what this is from the Indian context, especially in the context of the latest developments, what's happening globally, what's happening within India. Ankur, I want to start with you to try and sort of explain in a couple of minutes, what is it really that encompasses this framework? What are the key touchstone points when we discuss this subject?
So green and sustainable finance, Siddharth, is, while it has been in existence for more than a decade, but it has actually come to the forefront from a banking and financial services community more in the last 3-4 years, and very specifically post the pandemic, because I think the whole climate change agenda really hit people hard on the ground post the pandemic or around the pandemic. And I think at some point it used to be a completely non-for-profit or a very sidelined agenda for a few organizations. It became a mainstream thing in the last 3 or 4 years. In that context, I think the world realized that trillions of dollars is required if we need to move to a net zero world, which in a very, very simple way means if we need to ensure that the carbon emission gets neutralized over a time period. India, of course, has committed to a net zero target by 2070. And India alone needs $1 trillion by 2030 alone to reach that target of, because it's a multi-decade journey, right? So by 2030 itself, we need $1 trillion to achieve our first set of targets, whether it is in renewable power, whether it is in electric mobility. And that's where the role of banking and finance comes to play, to say, how can you mobilize capital, right, more effectively and direct that capital towards projects, towards institutions which are working towards climate change.
You of course work for a global institution, and therefore there's a global experience also, which I'll request you to share later on. Vineet, I'm coming to you. The first time I kind of related to this subject was many years back when I was part of a reporting team that wrote a story about how a particular lending institution was pulling out of financing a very large project because of carbon concerns. And I frankly didn't know what that really implied. To me, it was that banks are in the business of lending, and banks have a different kind of asset liability approach than all ordinary folks. And that was the first time I understood this. The point that Ankur made about the amount of money that is required, I'm linking this to another thing, which is the broader climate change goals that India is supposed to sort of adhere to, and developing countries like ourselves saying the West should mitigate that, they should give us the money. Explain this and put this in context for a lay audience like that we have.
So, first, thanks for having me here. So we had an NBFC, sets of people who were before us, and were talking about the world changing, and the song was melodious, but the reality is that if you are actually a lender today, whether you're a banker or an NBFC, invariably what you will see is there are external factors that go beyond what you normally do, are actually influencing decisions. You have heard of drought, you have heard of floods, you have heard about, and you're now hearing about even towns sinking. So Joshimath example is happening. But I mean, basically what is happening is there is a fairly significant change that is taking place that is influencing decisions on lending. And this is not something that is part of your diligence curriculum. Now, some people globally woke up to this crisis much earlier. So that's why the deal that you're talking about is because Europe woke up to that problem. Largely because they had more money. Probably some of that money went from here, but the fact of the matter is they woke up to that problem and started talking about it. But the world has been talking about this problem for the last 20 years in general. So you had many protocols. There's something called COP. I don't know how many of you know it, but we recently had, we're moving into COP 28 now, 27 or 28, whatever.
I remember a headline, sorry to interrupt you, that when one of the talks failed, the headline was COP out.
Yeah, COP out. So I think very simply put, just to put numbers in the context, so we have targets 2030, 2050, and 2070. We require $2.5 trillion. This is just India. $2.5 trillion of green financing for us to reach anywhere close to the targets that we have.
Again, I'm interrupting you. She said 1 trillion. Were you on the same subject or?
Yeah.
1 trillion till 2030, so 2.5 trillion.
And your 2.5 trillion is till when?
Yeah, so basically, there are different numbers, different estimates. These are all theory, but 2.5 trillion by 2030, 7.2 trillion by 2070. We require $7.2 trillion just India to do this. And the funny part is there is no dearth of money in the world. Roughly the global world...
You say that there is no dearth of money in the world, but 100 billion amount that was mentioned by the Indian Environment Minister several years back at one of these negotiations, the West never paid up. And, it's they who have polluted more than...
Yeah, you're actually getting into what they did not pay. The world has $400 trillion. So it's not really about the money is not there, whether the intent is there, and whether the intent is who bears the cost. So I think that let's start by trying to understand that India requires this. Why do you require it? Simply because steel, cement, all the things that you produce are massive.
Carbon footprint.
Yeah, we are actually basically massively throwing carbon in different forms into the economy. Now, if you have to change the process, you have to actually, let's say, look at India's green hydrogen initiative. Now, green hydrogen is way more expensive than grey hydrogen. You have to replace that. How will you convince anybody to use green hydrogen? Refineries or steel or cement, why would they use it? So somebody has to pay for it. Now, at this point of time, roughly, we are getting around, instead of 170 billion that we need to finance, roughly 44 billion is what is going. 85% of that is coming from Indian sources. Roughly 50% from public sector, 50% from private. Only 13% comes from outside India. That's inconsequential in the scheme of things that we are talking about.
Maybe Siddharth, I'll go one step further and say it's not about the East or West. We are a very globalized world despite the fragmentation that you're seeing in the recent years.
May I interrupt you?
Yeah.
Tell us why it's not, because from whatever I know about the subject, it's the West which has a far higher cumulative carbon footprint than a developing country like India.
No, so all I'm trying to say that you can't distinguish how much the West has to pay or how much the East. I think it has become a global problem, and that's why COP26 talks about it. And to give you an example, Standard Chartered is a global bank. We've said our footprint is in India, Africa, Middle East. All of those countries will go through a very tough time. We said we've committed $300 billion to green and sustainable finance up till 2030. Now that can come in a local currency form in India. That can come in the form of us trying to raise international bonds for our clients, or just purely funding renewable projects.
A direct question, and hypothetical one completely for the record. Let's say there was a telecom company that were to approach an institution like yours, not specifically yours, and they would you finance them because a lot of the towers still run on diesel, or would you encourage them to move to solar towers? How would it work? What I want is for the audience and our viewers to understand, how does green financing really work in reality, transaction level?
Sure. So when we look at any business to finance, whether it is telecom towers, whether it is power, whether it is shipping and infrastructure or ports, right? Our approach has changed in the last 3 or 4 years. You know, you can't expect industry to say, listen, tomorrow itself, to your example on telecom towers, switch off all your diesel and move to renewable and solar. That's not going to happen. But what we are encouraging our large clients to think, and it is actually already happening, is do you have a transition plan? Are you willing to make investments to start moving to renewable energy? Similarly for the auto companies, right? Are you starting to look at electric vehicles as a strategy, right? So it is a transition. It can't happen overnight. And a lot of international banks and institutions have drawn hard lines around not financing thermal power, though the last 12 months has thrown up new challenges on that, and we can talk about it separately. But I think it is about both the financial markets as well as the conglomerates and the corporates coming together and saying, listen, there is a transition. Right. We need money to arrive and get to that transition. It will not happen overnight.
The color of money is green, and the subject is green finance. The other question I want to ask you, and this is from what some companies tell us using that telecom example itself, transiting to solar-based in the long run is cheaper, but in the switch itself involves both a fixed cost and a transition. Who bears the cost in the Indian context? The end consumer? Because this is going to be expensive for the near term. Just like why I'm asking this question to everybody here is, if you want to plan to buy a electric mobility solution, a motorcycle or a car, they are 40, 50%, 60% more expensive than conventional. Vinit.
I think we are talking at two levels. One is this a problem? Is this a real problem? The answer is yes. Is this our problem? Answer is yes. Is it being created by us? Answer is no. Has somebody else created it? Yes, somebody else has done much more, because per capita consumption of the West is still way, way beyond what we are talking about. Should the West pay for it? Yes, that's what India is asking. That's the development world is asking. Is the West willing to pay? Answer is no, because they don't have the money, but they are making small progresses.
But you said there is so much money that's available.
So much money available versus the money that they are willing to give you are two different things. So I may have $400 trillion available. I am willing to give you few hundred million.
So quick question for entrepreneurs, for large, mid-size, established companies. If they want to tap into this global pool and become green and sustainable and be environmentally responsible, what are the changes that Indian companies need to make I'm going to ask you that question as well, starting with you.
So very simple things. You will not be able to export. The finance minister just simply said, West has come up with so what has happened is Europe is becoming very tough with its own corporates. Now when it is becoming very tough with its own corporates, the corporates have then revolted and said, well, you cannot allow us to do, we are uncompetitive. Basically, West companies are getting uncompetitive, given that we
And the Chinese are filling the space.
The Chinese are filling, or Indians will fill, or somebody else will fill. So what they are doing is they have come up, and they are very ingenious people, so they have come up with new taxes, which are called the carbon tax. And that is going to hit us very hard. So if you do not comply, your exports will suffer very soon, because the world needs to have a level flying field, and they will find their ways to do it. So
this when you talk about exports, it is across the chain.
Steel, cement,
textiles,
whatever,
everything.
Textile, everything. So you will not be able to, your exports will hit very hard because you will become uncompetitive.
Quick interjection, sorry, because I'm looking at the clock. Are Indian lenders waking up to this? How would you describe it? What is the Indian lending community doing when it comes to this subject?
So the Indian lending community, I think more than Indian lending community, I think the government has woken up to it. And the government policy, I mean, just read the green hydrogen policy, it will tell you that there is very clear idea. Who is green hydrogen aimed at? Green hydrogen is aimed at all the big guys. Yeah. Because if you do not consume it, you will be uncompetitive. So government will have to put in money. But then there is a huge amount of capital that we need to pull in. I'm actually 7.5 trillion. I don't think so. We have the capability to provide it. 170 billion is what you need today. 44 billion is what you can provide. After that, 13% is from outside. The rest is yours. That money you are already providing. Okay. Where will you get the remaining 75%?
Great numbers.
2 points. I like to look at the silver lining in the clouds here. Exim Bank raised $1 billion of green and sustainable bond 2 days back. That opened the capital markets. All of that $1 billion was raised from overseas markets. And hopefully a lot of that will get...
Here.
Yes, a lot of that will get deployed in the Indian ecosystem in some form or the other. Number two, 2 very large European oil and gas majors have made $1 billion plus investments in the last 3 years in Indian renewable market. Is that coming out of philanthropy? No. That's coming out of need, because they need to decarbonize and they feel India has a huge potential for renewable market. I can't get the same scale and size elsewhere. We've advised a couple of them. So that's why I'm saying it's not a problem which has to be defined by boundaries. It can be only solved if we think at a global level or scale.
Ankur, very quickly, what would you tell Indian companies, all size, that they need to do to become sort of green finance compliant, if I may use that term?
I think you'll be surprised that I was surprised actually to see almost all the large Indian conglomerates are super focused on this, because again, not because of philanthropy, because they know this is the future. If they need to deploy their investments into sustainability and green finance and green projects, they need to raise very large amount of capital, and that will not happen without transparency, without ensuring that their governance models are well put in place. And while the RBI and the SEBI have said that you need to have your sustainability reports, your disclosures need to be in line with your financial disclosures, and then there are agencies, rating agencies are actually now taking into account ESG parameters when they are grading corporates. So all of that needs to be done, and I think it is the same level of discipline that they have on the financial side that they need to bring on the corporate sustainability strategy as well.
Any closing comments?
I'll actually just give you almost a miracle story. You can actually copy it. So Avishkar is, we genuinely believe, and I met the Prime Minister and I told him we can attract $200 billion of global capital and never return it. So basically India's problem is you bring in capital, then you lose value, 3.5% every year, and then you return it, it becomes very expensive. We can attract $200 billion of global capital, go and grow trees all over India, and then just sell the carbon credits back, and the person who gave us money will make 10% odd return, while the $200 billion will remain invested with our poor and low-income population across India, create biodiversity, and create a good green India. That miracle is possible in today's world, which means you are taking billions of dollars of global capital, never returning it, putting it in the hands of very poor people, and yet actually giving a return to the guy who has given you $200 billion. That miracle is possible in this new regime, and therefore those who are in the field of finance can actually start believing in miracles. I'll just end.
Ladies and gentlemen, the Delhi perspective to what he said would be that he's just filled a large hole in the balance sheet. I hope the powers that be listen to this, and why this subject is very important. I'm going to sign off with what a lot of people in Delhi are experiencing. Also, that's a completely consumer-centric example, not totally relevant to this session. But in Delhi these days, you wake up in fear that are you going to be able to take your car out or get slammed with a 25,000 rupees fine. That's the consequence of climate and environment sustainability that common citizens are facing. So hopefully if the big corporates and the governments do it, we'll all stand to benefit. Vineet, Ankur, thank you very much for your time. With that, thank you for listening in. Bye-bye.
Thank you so much, Siddharth. Thank you to our guests as well. I'll just take a moment to thank our sponsors before we announce the next session, and also to share that Kyndryl, our technology partner, is of course our partner for the event. They also have a booth right at the entrance, you must have seen, and do visit to understand more on technology as a service. They'll be very happy to take you through some of that. Our knowledge partner, KPMG, energy partner, REC, sustainability partner, True Alt Bioenergy, digital transformation partner, Accenture, trade media partner, Media Infoline, and hospitality partner, St. Regis. Also like to thank our celebration partner, Radico, Spirit of Excellence, and digital media partner, Daily Hunt. The next session is on payment banks and small finance banks. What lies ahead? I'm Abha Bakaya, Senior Editor and Anchor with Business Today Television, and I'll be taking this conversation forward with Rajiv Yadav, MD and CEO of Fincare Small Finance Bank, Anubrata Biswas, MD and CEO Airtel's Payment Bank, Rishi Gupta, MD and CEO of Fino Payments Bank, and Sanjay Agarwal, MD and CEO AU Small Finance Bank. Gentlemen, thank you so much for joining us. If we could have you up here on stage, please. A big round of applause, everybody. So let's start off by putting things into context. You know, we faced a little bit of a speed bump during COVID, but things are now back on track. What have been some of the key learnings for you, in that time period? If we look at a 5-year journey, where are we at now? How are things coming back on stream? Rajiv, let me start off with you.
Thank you, Abha. Obviously, it's been a tougher phase for the world, for country, for everyone. So we can't deny that. But this world has, from a small finance bank perspective, a new bank perspective, clearly brought out the degree of diversification that we have in a portfolio. It has highlighted some of those elements. It has strengthened our compliance, our regulatory and our collection infrastructure, portfolio quality infrastructure. It's brought out new learnings on the risk models. Obviously, if I speak that this phase has taught us digital, I think it's taught everyone the power of digital. So that is a cliche in some sense. And just it has proved the resilience of some of the banks that were newly built, and the fundamentals, the strength of their business models, the strength of their teams, and overall governance. I think it got all tested. It's in some sense the stress testing of the models, and the fact that almost all institutions have come out strong out of this difficult 2.5-year phase. It's a testimony to the new business models that got established last 5 years.
Right. Anubrata, there's also been a major shift towards the secured side of business. So tell us, for you, what have been some of the key takeaways post-COVID?
So let me give two big trends, one obvious, one not so obvious, one linked to COVID, one not linked to COVID. The first is obviously digital, but I want to counter it with a little bit of data. If you really look at online purchase percentage of, say, large telecommunication companies, broadly now 55 to 60% of recharges is now online. That percentage was somewhere in 35 to 40%. It moved up to 65%. It dropped to 60%, but it's remained flat. This is a broad proxy for the fact that consumers are consuming more digitally, and that's going to continue. The second big trend is that we've seen increasing formalization and therefore greater usage of bank accounts in the system, primarily driven by first government subsidies and the second by the usage of GST, and therefore a growing percentage of digital transfers and withdrawals from accounts. How the payment back model fits in very sweetly into that is that we offer a service, one based on reach. We are closer to any Indian than any bank in the country. And the second, through digital, we are actually closer to more Indians digitally than any other bank in the country. To put it simply, we have a network of 350,000 banking points, roughly 60% of them in tier 5 and tier 6 villages. That's the largest banking network in the world. And the second is we are part of an application on the phone which has 80 million users every month, which makes it one of the top 3 apps in the country today. We've been able to hardwire, rewire that for better consumer experience, and as a consequence, we are what we believe in a small community of payment banks, such as Rishi of Payments Bank, who are profitable because they are at scale, leveraging these 2 pillars. Those are the trends I'd really like to talk about.
Amazing. Rishi, let me get your view as well.
I think when COVID hit us in 2020, there's a lot of stress in terms of what is going to happen. So I coined this COVID means creating opportunities in virus-infected days. And that's how we have built this entire model from the period of stress to rebuilding the model and then to further strengthening the model. I think that has been the game changer. I would say the biggest thing for me is the resilience of the customer. When the COVID hit us, you saw millions of people moving away from urban to rural. It was the reverse migration which actually happened. And everybody was looking at jobs, what will they do in rural. So a lot of them actually became our merchant points and started to do transactions through our platform. I would say a lot of things have been said by Rajiv and Ubrit in terms of digitization, in terms of the way the entire banking has evolved in the last 2-3 years. I think the customer has now many choices, apart from the fact that he has a choice to go to a branch, he has a choice to go to a mobile or a merchant point. There are different models which have evolved during COVID, and digitization has actually helped us, technology has helped us to reach the last mile, especially when we look at the fact that till now nobody was really worried about the 600-700 million people, how will they do banking. And government subsidies of the nature of PM Kisan, the subsidies around the COVID, when government reached out 10,000 crores per month, the branches were not working, the ATMs were not working. At that point of time, the entire subsidy disbursement happened smoothly. And that's the power of, I would say, the payments bank, the way we have evolved over the last 3 to 5 years. And especially, as Anubrit also said, many of us are now profitable. So we have made out a business case, a business model out of the fact that when the payments bank came out, people were worried whether there's really a business model or not. So technology, digitization, customer resilience, I would say, is one of the biggest things when I look at the era in the last 3 to 5 years.
Yeah, but things were a little different for you, of course, Sanjay.
Sorry?
I said things were obviously a little different for you compared to the others, but take us through your perspective as well on the entire market.
We all know about this, that this is a once in a century kind of event, and I'm running this business from last 27 years and haven't gone this kind of tragedy, this kind of despair, this kind of negativism in those days, right? But I'm very happy that, we were running a public platform, which is banks. So my key takeaways for 2-3 in those days that customer became very loyal to you. I don't know why. because my deposit actually grew rather than we were more afraid that people will take money out. But people started more believing in us and making our deposit grow and grow. And we actually also helped them a lot. So our bond with customer grown manifold. You know, I don't know why, because we were open in those days. We were doing many things for them. Even we were supplying medical help, or we were even counseling them. We were telling them the world become better and better. But our bond with customer gone to the next level. And you know, we generally lend to the semi-urban and rural markets, you know. And many people challenged us that, you know, because world is not designed for lockdowns. World is designed for 24/7 working, right? So if lockdown happened, you know, if my customer don't earn and pay, then what will happen to your asset quality? You know, you will be losing much money. But, you know, to surprise to me, you know, there was some schemes from government that, you know, you should have some kind of leave not to pay. But as soon as, you know, the normalization came in, people started paying you. You know, 60% people even paid you in the lockdown days. So that shows the resilience of the customer, right? So first key takeaway for me was the validation of my business model, and I have become much confidence that if people have survived COVID, people has given you money in COVID days, people has repaid you after COVID time, you know, then this business model is there for forever, right? And you know, the kind of employees, you know, because we were running a bank and we are essential services, you know, employee has to come and deliver banking services, and they were willing to come and give the, you know, their 100% to the public. I think that was really heartwarming, because to ask at those times that, you know, you come and deliver for the public, it was not easy for me, right? So that made me very proud of my team, you know. And third, how the world came together to come out from this situation was very heartwarming, because we all came together and handled the situation well. So in spite of so many differences, in spite of so many challenges we take every day in life, but crisis makes us one, right? So that's what the key takeaways for me.
The human element there.
Yeah, human element. Yeah.
Okay. Anubrata, let me come to you on the way forward now, what the future model's looking like. Because, you know, like I said, there's been a shift towards secured. You know, there are some challenges because we're heading into a high interest rate era. Cost of funds are high, yields are low, don't have that flexibility on the deposit rate front. How do you, you know, imagine maneuvering through some of the challenges now in the next couple of years going forward?
Well, firstly, I must place this firmly on the table. I'm not worried at all. In fact, I'm much more positive for a few simple facts. Firstly, you know, if you look at the consumer, ultimately the banking industry today is what the soap industry was in the 70s. You had one bar of soap. It was used for washing clothes. It was used for washing yourself. Fast forward that 30 years forward, you've got a wide variety of soaps which are used for manifold purposes, including cosmetics, to just the pure basic purpose of cleaning. The purpose of differentiation in banking is not yet well served, and consumer uptake is going to be very strong as a consequence of that. That's the first fact. The second fact is, what are some of the fundamental prisms of differentiation? Let me give an example. It's quite well known that banking, payment banks, direct banks, internet banks offer value and convenience. Our banks offer that. But one big understated factor of offtake was safety. 57% of urban India is fundamentally worried about their accounts getting exposed to financial frauds perpetrated with the UPI ecosystem, and therefore they do not end up using their primary bank account for digital payments. And the payment bank account becomes a natural secondary digital account which people uptake, choose and use. So there could be many prisms and therefore many reasons for people to uptake formal banking services more. And finally, a little provocatively, typically when you lend to a customer, you tend to start looking at margins. You mentioned cost of funds, and you start looking at what are the NIMs you make. We look at it very differently. The model is very simple. Today, we serve over 50 million users every month. We earn 20 rupees per user per month. By the way, we tend to spend 18 rupees. We are firm believers in the fact that in a 500 million underbanked opportunity in India, the 50 million can become 100 million, and the 20 rupees can become 40 rupees. And you can do the mental maths yourself of what that means in terms of revenue growth. But most importantly, we believe that that model will finally serve India well.
I mean, that's when you think of that outlook, the numbers are mind-boggling. You're both looking very skeptical there. So do you want to add something? Do you want to jump in here, Rishi?
So for what?
On the numbers, I mean, are you in agreement with the kind of scale that's possible on this front?
Yeah, of course, but just to add on from my friend is this that from last 5 years, we are seeing one thing after one, right? We saw demonetization, we saw GST implementation, we saw NBFC crisis, then we saw bank crisis, then we saw the COVID, right? So I think we as a business runners need to handle this kind of crisis, right? So there is no perfect world. So in my opinion, whether the interest rates goes up or there is a Ukraine crisis or there is maybe anything more coming in, we as a bank has to run our business, right? So we need to handle it by balancing it out, whether you want to hike your rate, you want to lower your OPEX, or you want to manage on the credit cost, or you want to lower down your growth, it's just management. But I think India is on the different terrain, and we as a banker are too much excitement around us, right? Because if you grow by 7%, banking will grow by three times that, right? So 25%, 30% growth will be there, right, in for next 10 years. So I'm equally excited to be part of this whole journey.
So clearly all of you are very optimistic on the state of the economy, the way forward, because when you're talking about your plans, and you're all nodding now, you're all in agreement, you're very gung-ho on the prospects.
Yeah, absolutely, and especially when I look at the new generation banks, the SFBs and the payments bank, we have come in an era of technology. When India Stack is there, digitization is there, we don't have any legacy systems. Our customer OneView is there, we are built up on data, and now OpenAI and AI are coming in. So a lot of those technologies and systems are already there. We are looking at the next 600, 700 million people who don't have banking per se. And as payments bank, we started with payments and managing cash withdrawal, remittances, basic banking services for which every person goes to the branch, especially the mass market segment which we're talking about. Now from payments, we have moved to liabilities. Tomorrow we'll move to credit, investments. So the product offering itself is quite big. Plus with technology, technology is a big leveler. It doesn't differentiate between whether you are rich or poor, whether you are educated, non-educated. To some extent, everybody can use an app. 80% of our merchants, 40% of them are graduates, 80% of them are on social media. We have 65% of our customers who are using WhatsApp, UPI services. So technology has actually made it possible for us to grow, and it's infinite options which are available. You just need to build the right products for the right customers. As I say, if a customer needs Maruti, give him Maruti, don't give him Mercedes. And especially the new generation banks are very focused in terms of the kind of products they are building, because we are servicing a particular set of customers. Like if Sanjay is serving MSME, so he is largely serving a MSME. So his focus is to develop products on MSME. He is not getting confused with corporates and other side of, unlike many other bigger banks and entities. So opportunities are immense. You need to just keep your focus, get the right products and get the right technology in place so that you can harness the opportunities. And I think that's the way I look at in India. In fact, that's the brightest spot in India amongst all the countries which we are hearing about.
So what about all the competition that's also coming in from some of the private banks? The small private banks, they're also shifting into this space. Is that a challenge with the landscape? We've already seen small finance banks have maybe 1% of the overall market. And the opportunity is huge, Anubrata, as you said. But there's also heightened competition in this space.
I think when we walked into these licenses, the competition was equally intense, and in some sense we did not have the credibility of the track record. This was a very basic question which was asked to almost all of us who were raising equity in the private round or in the public round, that how would you raise deposits? Deposits will come with a lot of trust. Why would people, sort of give you deposits? It's a very basic question on deposits. And as Sanjay said, pretty much we had principal confidence on the fact that on the lending side, we have a niche segments to the point Rishi was making. The markets that we attack on the lending side are in the rural areas, the semi-urban areas. It's a vast majority. We have grown up by doing that business in a profitable manner, whereas some of the bigger banks do that as a PSL target, which probably could be a loss-making objective for them or minimize losses for them. So in that context, this was a core profitable business for us, which had already grown up. So we are not really worried about the asset side of the business. On the liabilities, again, the fact that the market is so huge, and frankly, to the point Rishi made, the technology being a great leveler. So we had the reasonable confidence that for the size of the balance sheet that we were building, we're not really building a 5%, 10% market share out of the larger banking system. We were starting all small with decimal numbers, and so what we have seen is that as long as we can service our customers appropriately, what we call ourselves doorstep service, digital offering, and with the right deposit rates. Okay, clearly the customer needs all three, and if you service them with all the three components, you should be able to raise reasonable deposits, and we do have to give a slight premium to our deposit rates, but luckily, again, as Sanjay was alluding, because of the kind of business that we do, with the kind of NIMs that we enjoy, are able to absorb a 50 to 100 basis point higher deposit is there. The business model remains profitable. And in that framework of the deposit franchise, what we have been able to do is, we've been able to raise deposits in line with our asset growth, which could be 20%, 30% or 40% in some years. So actually, we are a little less fearful of competitive position right now than what we were 4 years back. And we have created the way of working, and we have learned that over the last 5 years.
And yes, please. And I was actually going to even ask you certain challenges that you found in the model with regards to scale as well.
No, so I just add on what Rajiv had just commented, that if you go back and see last 5 years, every good financial institution, be it bank, be it NBFC, has grown north of 20% in this country in spite of so many challenges, right? And we were around 2-3 trillion kind of economy, right? What we are discussing now, next 10 years, India will become $10 trillion economy. I was in US last year when, I figured out that in a $30 million, trillion dollar economy, there are 4,000 banks. 4,000 banks, right? In India, how much? We are just 30 banks in India. If you count, PSU will be around 10, private sector around 15, and then we have some foreign banks, right? So, and then how many NBFCs, right? So scale we haven't seen in this country as of now. In my opinion, next 10 years, I don't think, to be very honest, there is much more around competition. Because if your top 10 institutions are growing not of 20-25% every year on year, where is the competition? If there is so much of competition, then nobody will grow even 10-15%, right? So I think my subject is this, that we need to understand the customer, build product, build team, build service levels, and just go and execute. It's an India story, right? And we need to decode India. Let's not decode Europe. Let's not decode US. Let's decode India. And decode means that let's go places. Now North is looking so great. Just go in there and just build the businesses around it, right? So I think the businesses need to build beyond Bombay, Bangalore, or Delhi or Calcutta, right? So I think if you go there, I think there is no competition. But if you want to really work on Bombay, you will see 50 banks working in Bombay, right? Mumbai. So I think my sense is this, that you need to figure out the markets, you need to figure out products, figure out the whole team around it, and just deliver it, I am actually...
Geographies, whether it's average ticket size, whether it's demand. I mean, where are you seeing those hubs of growth going forward? I mean, India is huge, but if you had to pinpoint a couple of key drivers.
So at least I can say for ourselves, like when we started, we went from west to east, starting from Maharashtra, we went all the way to Bihar and Jharkhand. The Bimaru states, as they call them, are being our biggest business drivers. Because you can say the lack of banking, the lack of infrastructure was an opportunity for us to set up that business in that. Now when you look at, as Sanjay also said, northeast and east is again a big opportunity from a geography point of view. South is heavily banked to a large extent. But within South also there are niche areas, like Kerala is again a niche area, somewhere in Andhra, Telangana also, you can do businesses. So to that extent, I would say in India, there is, within India also, there are states where there's opportunities, and within Bombay also. When we call Mumbai has many branches and there are 50 odd. But if you want to service somebody in Dharavi, if you want to service Dombivli, these niche places where the migrants are more, the income levels are lower, you will not see many branches and ATMs in those areas. So opportunity is there everywhere. You just have to identify the right business model, the right kind of technology, the right kind of products, where you can actually service those customers. So I would say opportunity you have to look at from a point of view that whether you want to really do the hard work or not. If you want to do the same thing, see, low-hanging fruits are not there anymore. So if you are thinking that you can do more of housing loan, car loans and all that, there are only that much increase in production and there's many houses coming in. But you have to develop products, you have to customize products and identify geographies and the right teams to do that. I think that's where the key is. And that's where some of the new banks, the differentiated banks, are making a larger impact.
Anuratha, you want to jump in?
You know, frankly, I don't want to give a very general answer. I'll give you an example, right? Building on this point of differentiation which I mentioned of safety, right? Just as a factor. So we are actually the only bank in the world which has built a third layer of authentication product with a telecom company to serve an authentication message on a SIM. Yeah. So just very simply, apart from the OTP which you get a message which flashes on your phone which you have to accept or decline for a transaction to go through on your account. Very surprisingly, 80% of usage of that product is what we call an urban sophisticated cohort based in metros and tier 1, right? More than 1.5 million people use it daily. So I just want to resonate with Rishi and just give a slightly different example because of course the bottom of the pyramid is well established. The fruit seller in Bombay is not, well serviced. But with the right product set and the thought process, you actually have significant uptake for any bank of any size, which is possible. The other thing I want to mention and I want to build up on what you were saying, and just give me a prompt if you're running short of time, is look, we are unable to predict the power of convergence, which is happening in India today. I was in Singapore representing India in the Singapore Fintech Festival, and we were in a closed panel of digital banks. The real pain of a digital bank just to do KYC in a country like Philippines or Indonesia, which does not have identity in a biometric form, is unbelievable. So we are blessed already with a world-class biometric-driven identity stack and world-first payment stack. So you've got identity, you've got digital, which is now going to drive the next shift, which is going to be data, which will drive the UPI movement for credit. And that will be participated by players such as payment banks through frameworks like Open Credit, using account aggregator data, or even data. By the way, we as a bank generate around 650 million data points every month. So that's going to happen. And we don't know what the power of that model is going to be as it unlocks. And of course, Sanjay's business, small finance bank models are going to really leverage that at scale.
Just to kind of take on that, we don't know the power, but it's also sometimes a little overwhelming because you have big tech also getting into this, and no one is able to accurately predict the landscape. So everyone is, just to play devil's advocate, but the market is equally split between the opportunity as well as the risk involved as people try to get into this. But you touched upon how we have a lot of things to our advantage, and clearly in terms of policy makers as well, they're intent on making this a reality and giving it the support that it needs. In your eyes, if you were to look into the future, and you were talking about 10 years, Rishi, but if we were to look at a more near-term future, what is the most immediate impact or reality that you see of some of this coming to light, that we start to see in play, and really see the true implementation of this? Because we've been talking about the opportunity and the growth, but as you said, it's taken a while to come. How soon are we now going to start to see the impact, the real impact?
You're asking me? Okay. No, so I think this time the basic difference what I am able to figure out from the system is this, that we as a country are more committed. You know, I think this kind of commitment, this kind of enthusiasm, you know, I haven't seen in last 15, 20 years, to be very honest. I think that is real takeaways, you know, why we'll be more successful, why we should be more successful in coming years, right? And I think I'll be very honest that the way the government has played in the way they handled COVID, way their purpose is coming so straight and with so much pace. You know, regulators are doing many things. Our whole startup system, our whole tech system is being acknowledged worldwide. Our demand is huge, infra and all those things. Geopolitical positioning, we are very luckily positioned ourselves, so many manufacturing is coming, and the internal consumption, right, is now the realities, right? So I think what we don't need to do is this, that let's not build more hype. Let's not be around a number. Like, you know, I read always that this time GDP will grow by 7%, tomorrow news is 6.9, then they say 6.8. Baba, 6.8 bhi acha hai, 6.5 bhi acha hai. You know, let's not be so linked to your so much of number, right? Let's just flow. Let's just go and execute, right? So I'm very gung-ho on the whole aspect this time. I know we have many missed opportunity last decade.